It's really hard to have any kind of negativity on the U.S. market.
The setup here is that it's all about tech.
Expectations right now are much higher than they've been over the last 3 years.
Just meeting earnings is not enough.
Anything that looks like it's going to threaten that earnings picture is going to be problematic.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Tuesday within striking distance of all-time highs. Equity markets advancing heading into the Fed's two-day meeting. As the explosive rally in precious metals takes another leg higher, President Trump is threatening to raise trade tariffs on South Korea. This time, the market isn't blinking.
So equities are just piling through, ignoring some of the noise. When you look at gold, potentially that debasement trade continues. But as we said last year, and that's continuing through this year, uncertainty is a feature, not a bug. The president is clearly annoyed that the South Korea legislature has not put through this deal. A lot of this has to do with the investment deal. Some of these companies are going to make investments into the United States. So he's coming out with a 25% threat. Does it mean we land here and end here? Potentially not. But the president is using trade and tariffs as a way to negotiate once again.
I'm always thinking what's new? What's new about all of this? And what's new in the last week or so is that trade partners are now looking elsewhere. The EU and India putting together some kind of free trade deal. And then we hear from the British Prime Minister Keir Starmer speaking to our colleagues over in London, who's not going to choose between China and the United States. And ultimately, that's a choice this administration wants these countries to make.
And it comes on the heels of Mark Carney, the Canadian Prime Minister, going over to Beijing, looking at potentially tightening some ties when it comes to the economic sphere. This is what Keir Starmer had to say. I'm often invited to simply choose between countries. I don't do that. Actually, Keir Starmer, that's a very wise decision. They are looking to China to have economic ties, even though they say this will not impede on their relationship with the United States or hurt their national security posture.
The market really is not blinking. Equity futures up by 0.25% on the S&P 500 on a 4-day winning run. Can we make it day 5? This from Max Kettner over at HSBC. We continue to put little weight on geopolitics. Seemingly, he's not alone. He says this: it's about US rates and rates volatility and near-term growth expectations. And as for near-term growth expectations, we'll speak to a range of guests this morning. They're getting higher and higher and higher.
Well, you heard David Solomon overnight talking to Stephen Angle, our colleague over in China, and he was talking about the deregulatory push that we see out of the United States, and he's talking about the fact that things are looking incredibly optimistic and rosy. You have to remember, there's a fiscal impulse around the globe, especially here in the U.S. Potentially when you have some tax refunds coming down the pipe, it is a constructive environment for a lot of individuals that are ignoring the noise, ignoring any geopolitical ruptures, and just looking through at the fundamentals and the data.
Are we going to see it in the corporate earnings through the next hour or so? GM reporting later this hour. In the next hour, we'll hear from American Airlines and from JetBlue too. UPS just moments ago, this is their outlook. They now see 2026 revenue of about $89.7 billion. Compare that to the estimate of $87.95. You want to see more of that throughout the morning, Annmarie. That stock is up by 2%.
Yeah, they're doing very well. So they have better revenue posture going into for 2026. Beating the estimate handedly also comes at a time when people, were thinking maybe tariffs, all of this was going to damper some trade and commerce. It's not happening with UPS, which shares are now rising in the pre-market because of this. In 2026 sales outlook beat big time.
A better outlook from UPS. If you're just joining us, that stock is up by 2% in the pre-market. The numbers look like this for 2026: revenue of about $89.7 billion. That outlook versus the estimate of $87.95. The stock is higher by 2.2%. Coming up this hour, we'll catch up with Cameron Dawson in just a moment of New Edge Wealth, with stocks looking for a 5th day of gains. Kit Jukes of SocGen with the dollar very much under pressure. And George Goncalves of MUFG as the Fed's 2-day meeting begins. We begin this hour with stocks within 1% of all-time highs. Cameron Dawson of New Edge Wealth looking ahead to earnings, writing with an acceleration in revenue growth, a surge in margins to new records, and a big broadening of companies who are driving earnings. The big question for 26 is, how much room is there for this normal margin expansion to go? Cameron joins us now for more. Cameron, good morning.
Good morning.
Normal. Let's get into that. Yeah, just frame how massive the margin story's been in the last 12 months.
It has been incredibly surprising, and we even would frame it as a miracle, given the fact that how much you threw at corporations over the course of 2025 with tariffs, which we know were primarily borne by corporations. We had that Kiel Institute report that said that 96% of tariffs were borne by the U.S. consumer and corporations. So companies had to do a lot of blocking and tackling in order to just keep margins flat, but they actually expanded them in 25 by over 100 basis points. And that's without a concomitant acceleration in revenue growth, which is typically the relationship that we see. So when we boil it down, it comes down to productivity that is likely a function of a lot of investments that came out of the pandemic. And it's also a lot of labor productivity. There's a big dynamic where we have labor wage growth slowing to a material extent, which means that wages are not causing as much upward pressure on margins at the same time as workers aren't switching jobs as much. So the workers that you have are becoming more productive, and thus you get the margin expansion. The last point is this probably doesn't have a lot to do with AI.
Why not?
Because AI is still in these test phases. AI is still in testing to see how much it could impact growth. This is not AI necessarily causing people to fire workers. It is supplementing workers. Maybe at the margin, it's causing some companies to not have to hire as many low-end workers. You can see that with college-age unemployment rising. But this is likely not an AI story of what we saw in 2025, which raises the question, is that what is baked into 26 estimates? 26 estimates have 200 basis points of margin expansion baked into the forecast for $310 a share. That to us looks like a productivity boom, another productivity miracle.
Given how you're framing this, it sounds like you think there is pretty decent downside risk here into the year ahead.
So let's think about the cadence of earnings growth through the year. 8% growth is expected for this quarter. It's coming about bang in line with that 8%. That's very different than the last 2 quarters of earnings season where you saw earnings growth come in about double what was expected going into the quarter. That 8% accelerates to 18% in the second quarter, 21% in the third quarter, and another high teens in the fourth quarter. So it's not a big thing to say that there is a high bar for earnings to jump over. It's not to say it's not achievable. There's a lot of parts of the economy that didn't experience great earnings growth over the last couple of years because of the concentration in just Mag 7, but that is still an extraordinarily high bar for this market just to meet expectations, let alone beat them.
Well, if anyone's going to be jumping over that bar, that 200 basis points in margin expansion, what kind of companies are prepared to potentially do that?
Yeah, it's probably those that have the most ability to apply AI quickly into their workforce. So those people who have a lot of workers, maybe that they're lower productivity, a lot of wage costs. But I think the big question is, can we still see the degree of margin expansion out of the tech names, which has been so extraordinary and one of the reasons why this market has levitated so much. If we look at tech companies, the Mag 7 or FANG names have grown their margins by 10 percentage points in the last 3 years. A lot of that is because they simply were able to raise prices so much. There's a lot of monopolistic pricing power for some of these businesses. They were able to cut headcount significantly. And yes, you had some benefit and boost from AI, but it really was more the good old-fashioned blocking and tackling of margin expansion, not necessarily this big step change function and technology yet.
Honeywell was talking about physical and AI and how pilot projects are now being spread out to actual adoption. Is this going to be the theme for this year, if you're able to adopt in physical AI?
I remember going to a Honeywell Analyst Day probably 10 years ago, and they were really excited to roll out this VR system in order to fix pipelines. The reality is that a lot of these technologies have been being rolled out for quite some time. We used to call it big data before it was AI in industrial land. And so what you've seen is these kind of normal sort of margin expansion that is typically then passed on through to customers, not necessarily driving big upside to the margins that are experienced by the businesses.
It really sounds like you're not buying the hype around the AI story. Is that a fair characterization? That's what I'm feeling, just sitting here listening.
I think that the productivity from the actual application of AI is going to take longer than people are expecting. That's very different than the benefit you're getting from the build out of the infrastructure of AI. which we can see the earnings benefit immediately. You can look at it in the nuclear names, you can look at it in the power generation names, you can even look at it in some of the commodities, of course, the semiconductors, the memory stocks. That's the immediate benefit. The actual benefit of the application, that broadening benefit of it, I think that still remains the question of when it will come and if it will come as quickly as what's being priced into 2026 earnings.
Cameron Dawson of New Edge Wealth is going to be sticking with us. We'll explore some of these themes in just a moment. Big 48 hours coming up for big tech when we start to get earnings from Meta, Microsoft and the others all report over the next week or so.
I love what Cameron was saying, though, how a lot of this has already been happening in terms of the physical AI world. Actually, it's just been called big data. Now they're just rebranding it, it sounds like, with some C-suites.
Futures positive this morning by about 0.25% on the S&P 500. With an update on news worldwide with your Bloomberg brief. Joining us now is Yahira. Hey, Yahira.
Good morning, John. UPS shares are higher, up 4.5% in the pre-market after the shipping giant's fourth quarter earnings exceeded estimates on the top and bottom lines. For the full year 2026, UPS is expecting revenue to be approximately $89.7 billion, beating Wall Street expectations. The outlook marks the first time in a year that UPS has provided full-year sales guidance. Meanwhile, UK Prime Minister Keir Starmer says he won't choose between the US and China as he flags significant opportunities for British businesses ahead of his trip this week to Beijing. Starmer told Bloomberg he can meet President Xi Jinping without angering Trump or harming relations with the US. He is scheduled to travel to Beijing next week. And U.S. Border Patrol Commander Greg Bovino is leaving Minneapolis following public outcry over the killing of 2 U.S. citizens by federal agents. The White House says it's dispatching Border Chief Tom Homan to the city to ease tensions. President Trump also saying he's considering independent investigations into the shootings. That's your Bloomberg brief. John.
Hey, Yahira, thank you. More from Yahira later this hour. Up next on the program, ongoing trade tensions.
Canada doesn't live because of the United States.
He spoke to Prime Minister Carney, who was very aggressively walking back some of the unfortunate remarks he made at Davos.
Up next, we'll catch up with Bloomberg's Tyler Kendall, live from New York City this morning. Good morning. Morning for earnings coming up. This is what it looks like. Later on this hour, we'll hear from GM, General Motors around 6:30 Eastern Time. In the next hour, American Airlines and JetBlue, Boeing as well. Moments ago, we heard from UPS. Check them out in the pre-market. Their stock is higher by about 2%, almost 3 percentage points higher now. Heard from the company moments ago saying the outlook for 2026 revenue looks like this: $89.7 billion. The estimate was $87.95. So that's an upside surprise and a beat for the outlook from UPS. UPS trading higher by 2.8%. The broader equity market doing okay as well, coming off 4 days with no losses on the S&P 500. Can we make it day 5? Up by 0.25% on the S&P 500. On the Nasdaq, up by 0.6. Under surveillance this morning, ongoing trade tensions.
Canada doesn't live because of the United States. Canada thrives because we are Canadian.
I was in the Oval with the president today. He spoke to Prime Minister Carney, who was very aggressively walking back some of the unfortunate remarks he made at Davos.
So here's the latest this morning. Tensions remaining high between the US and its allies after a call between the president and the Canadian Prime Minister. The president also threatening to raise trade tariffs on South Korea, saying the country is not living up to its end of the trade deal. Bloomberg's Tyler Kendall joins us now from Washington for more. Tyler, just to pick up on the Treasury Secretary words, the Prime Minister of Canada was, quote, aggressively walking back some of the unfortunate remarks he made there at Davos. Was he?
Well, at this point, John, what we've heard from Prime Minister Mark Carney is that he's not pursuing a free trade agreement with China, which is what we've heard this administration ask Canada not to do. So at this point, it's not totally clear exactly what the Treasury Secretary was referring to in this private conversation between President Trump and the Canadian Prime Minister, though it does appear to be an opportunity for perhaps some de-escalation from the Trump administration's threats. Because, John, ultimately, what we've seen over the past few weeks has just been a re-escalation of potential upgraded tariffs, even if that ultimately means that the administration walks it back, right? We have this 100% threat on the table against Canada. We also saw renewed tariff threats against those European allies who have rallied support around Greenland. And now we have this threat against South Korea. And while perhaps we knew that tensions were escalating there, for example, I had reporting on the terminal just last week that there is a growing unease in the U.S. with how South Korea is allegedly treating U.S. tech companies. This is a clear escalation on the Trump administration's part, but our own analysts at Bloomberg Economics say that the threat likely won't go into place. This is more about applying external pressure for a domestic outcome to speed along the approval of the package agreed upon between the two countries in South Korea's parliament. Now, John, of course, we're watching closely what these potential impacts could be, not just from the administration, but how our allies are now looking elsewhere. Of course, you have Carney striking this trade deal with China, but then also worth mentioning, new this morning, the European Union striking a huge trade pact with India after nearly 2 decades of negotiations. There are definitely questions here about what perhaps spurred that timing.
Tyler Kendall down in Washington. Tyler, thank you for jumping on for us. Think about the objectives of these tariffs: bring manufacturing home, national security, raise revenue, all of that. The other one we've talked about consistently is to get China to change its economic model. And if Sir Keir Starmer, the British Prime Minister, is speaking to Bloomberg over in London and saying we're not going to choose between China and the United States, that just tells you how difficult this is going to be.
It's incredibly difficult. And then also, to Tyler's point at the end there, what do you think spurred this last minute trying to get it over the finish line after 2 decades of negotiations between Brussels, which we know nothing moves quickly there, and India? It's likely this pressure by the President of the United States. You know what also is interesting? Bloomberg Economics did a study. Only 27% of Trump's tariffs have actually been enacted. So this is why it is so hard sometimes for the market to understand what is real and what is just negotiated.
Still with us around the table, Cameron Dawson of New Edge Wealth. Cam, do you just look through a lot of this now and ignore it? Can you just ignore it?
Yeah, embody the spirit of the Kospi this morning. So the Korean stock market is now actually up after those threat of tariffs. And I think the question that we have is that if everybody's expecting a taco, do we actually not get one? Because it's a classic boy who cried wolf scenario, which is that you warn of something, it never happens. And then when it's too late, it actually does happen. So the question is, does this lack of market reaction actually push Trump to potentially talk about even further tariffs or follow through on them to get that 20% number of tariffs that are actually completed up higher?
I'm trying to keep up. We did get higher tariffs last year.
We did.
It didn't show up in the data in the way people thought it would. Mm-hmm. And I wonder how much comfort investors and economists are also taking from that coming into 26.
And I think it's fascinating that you have a company like Amazon starting to come out and saying just now we're starting to see the tariff impact because of all the inventory dynamics and inventory pull forward. And maybe the greatest folly for forecasters in 25 is that they thought tariffs would be the equivalent of shutdowns. Right? Shutdowns impacted the market immediately. They impacted earnings immediately. But the reality is that because of all the steps that supply chains go through, because of all the preparation in advance, tariffs simply weren't passed on immediately to consumers. Now, there's pockets of areas where we've seen tariffs impact consumer prices, but when you put it into the grand context of broader CPI data, it's not moving the needle as much as people expected.
Cameron, you talked about how 96% of tariffs were borne and paid for by U.S. companies. I know you have thoughts about IEEPA. We are still waiting for the Supreme Court ruling. Likely it's going to happen maybe the earliest, the end of February. How do you think the market is going to react to that?
Yeah, I think the question is, will the equity market likely cheers because it effectively is just a flow through down to the bottom line, boosts margins even more. Maybe that's how we get to 200 basis points of expansion. I think the more fascinating point will be how the bond market reacts, because the bond market having this extra tariff revenue has certainly allowed it to not have to issue as many treasuries as many people were expecting. It's made deficit statistics look a lot better. So if you actually were to see a reverse of this, you could have even more funding pressure. And then the question is, does that move yields up across the curve? And is that something certainly that we know Treasury doesn't want?
Do you think it's knee-jerk, or you think actually some of that could be sustainable?
In the bond market reaction? Yeah, I think at the end of the day, we think the bond market is simple, that it just follows effectively economic surprises in the U.S., at least for the 10-year. And so if you're in an environment where you have a release of tariffs and you have a little bit more funding pressure, yes, we would expect bond yields to move higher in that scenario because it could be effectively growth positive, but funding negative for the Treasury.
And what if we're in a government shutdown at the same time?
Yeah, there's the big question, because yields probably were lower in the fourth quarter of 2025 because we didn't have economic data, because we weren't getting those economic surprises to move yields one way or another. I mean, I think stepping back, we have to appreciate that Atlanta Fed GDP now is at 5.4% for the fourth quarter. We printed nominal GDP at 8.2%, and yet the 10-year Treasury yield is effectively just flat. So again, we would think probably lean towards upside surprises on that front.
Total snooze. Volatility so subdued, 10s at 422. And given, throw in the mix, what's happening in Japan as well. JGB market exploding last week. And I think it's fair to use that language when you see a 20 to 30 basis point move and the long end.
Yeah, and the wild thing is that the MOVE index, that Bank of America bond market volatility index, was actually lower on the week last week. So we saw all of this movement, and I think it's important to appreciate bond market volatility being low is good for overall market liquidity, meaning that in order for valuations to stay at high levels, in order for credit spreads to stay tight, you need bond market volatility moving lower, and that's been a powerful market driver over the last 3 years. And if that were to turn in the other direction, that would be liquidity negative and likely usher in more volatility for risk assets.
I wanted to finish on a midterm risk. Let's just finish on that. So in November, we get the midterms. The president's polls right now, Republican polls, are not heading in the right direction. That's a problem for them. When the president's finding himself in this position, he's leaning on quite populist policy proposals. Is it making some sectors less investable than others right now as you look across the equity market?
Well, my colleague Brian Nick has been joking that probably the number one policy priority for 2026 is don't let the stock market go down. Because if you think about how important the stock market has been to the U.S. economy and fueling that upper income spending growth, having a prolonged period of stock market volatility, which does typically happen in midterm years. Don't forget, midterms give you the best earnings growth, but typically the worst equity market returns. So it's this paradox that we could find ourselves where the policy from Trump and trying to be able to push markets higher might just be pushing on a string simply because of this midterm election dynamic.
The proposals on the table right now are certainly not market friendly. The president's going after stock buybacks in certain sectors. The president's going after investing in housing. This is all things that people might want to hear in the electorate. The president's going after capping interest rate costs. That's not going to help the financials. And some people might make the argument it's held them back over the last few weeks.
Absolutely. It's populist policies like it is in any election year, like we saw in 2024. We're seeing it again this year. And not all of these, depending on the industry, is good for them. When you look at what's going on with the defense sector, you look at what's going on the home builders and housing. And you know what? We're probably going to hear a lot more of them tonight because the president is giving an address in Iowa.
Does the president care about the equity market in quite the same way coming into this year? You're making the case that he does, but I'm questioning whether that's actually real or not. I don't think you introduce ideas like capping interest rate costs if you care about the stock market.
Well, I think the key difference is that everybody talks about the Trump put. A put is rarely priced at the current price for its strike price, meaning that the Trump put is certainly lower than it is today, where stocks are trading today. However, if you were to see a period of deeper and more protracted equity market kind of volatility, this would be very negative for higher income growth and spending. That's been the key driver for the U.S. economy. So I don't think it would be something that would be tolerated for very long. Question is, does it work with whatever they're trying to do to fix it?
When you talk about his put price, you're basically saying he has a higher threshold for pain this time around.
Well, and I would say that the other point of it is that maybe in equity markets, possibly, it's really the bond market. It's that yippee bond market that gets him to act. And that if you were to see bond yields spike up higher, that's likely the thing that causes a reverse course in some of these policies.
No yips right now. Cameron, good to see you. Cameron Dawson of New Edge Wealth. Bond yields higher by about a basis point, 10s at 422.
Snoozy. I mean, it's not where the Treasury Secretary would like to see, but he's certainly not going to be upset at this because, as you said, there's not been a lot of volatility here.
Closer to 4 than to 5, and I'm sure the Treasury Secretary would take that given what's happening elsewhere. Coming up on the program, we'll catch up with Kit Jukes of SocGen as traders bet big on a deeper dollar sell-off. Plus Danny, as your morning movers, health insurers sinking on proposed plans for Medicare payments. We're down across the board. That conversation up next. Live from New York City. You're watching Bloomberg TV. Four days, no losses on the S&P 500, the longest daily stretch of the year so far. Yesterday, though, notable, the first back-to-back losses on the Russell, the small caps, for 2026. This morning, we bounced back by 0.3% on the S&P, up by a quarter. On the Nasdaq, up by 0.6. That's the price section. Let's get you some morning movers with more. Here's Danny. Hey, Danny.
Hey, John. Shares of health insurers tumbling in this morning's trade. United Health, CVS, Humana, all down at least 11%. We have the new plans from the government on payments for private Medicare plans, and they are keeping them flat, or almost flat, 0.09%. Just to underscore how much of a disappointment this was, some analysts were projecting as much as a 6% bump. So shares tumble off the back of that. Elsewhere this morning, the memory chip stocks having another good morning, something we're used to. Micron specifically outperforming, up nearly 5%, announcing plans to spend about $24 billion in Singapore to help ramp up its production of memory chips. It's something that we know that there is a shortage at the moment, so those shares moving higher. Finally, Salesforce, those shares also up 2.2% to the pre-market this morning, getting a $6.5 billion contract with the U.S. Army. The idea is to help adopt more commercial licenses for the U.S. Army. It is a 10-year contract. That's sending shares higher in the pre-market, John.
Danny, thank you. More from Danny in the next hour. On our radar this morning, the British Prime Minister, Keir Starmer, saying the country can balance ties with both the US and China. Starmer telling us here at Bloomberg, ahead of his trip to Beijing, he's prioritising economic growth and remaining firm on national security. Elsewhere, President Donald Trump threatening to raise tariffs on South Korean goods to 25% from 15%, blaming the country for stalling a major trade deal. New rates would be targeting essential sectors, including autos and pharmaceuticals. And finally, just moments ago, General Motors earnings just crossing that stock in the pre-market is down about 1.67%. Here's the outlook for them. They see 26 adjusted EPS in a range of $11 to $13. The estimate was $11.79. Also in the mix, approving a new $6 billion share repurchase authorization. The latest from General Motors.
Yeah, stocks are lower, even though they do have a wider barrier when it comes to the adjusted earnings per share. When it comes to General Motors, they also seem to be doing well when it comes to international. Also, I thought this caught my eye, Jonathan, introducing conversational AI with Google Gemini. How many more companies are we going to see decide to pick which AI player they want to start to team up with?
Got a number on tariff costs. The companies have been pretty transparent about a lot of this.
Now.
Gross tariff costs of $3 to $4 billion. That's real money.
That's real money. And actually what comes to my mind is just the idea that USMCA is going to be renegotiated this year. And a company like GM is going to be one of those companies that is going to be stuck in the crossfires between Canada, Mexico, and the United States, because we know how many times does an auto pass a single border when it's being produced.
Stock all over the place at the moment, just turning mildly positive by about 0.8%. Joining us now is Bloomberg's Craig Trudell. Craig, welcome to the program. Let's get into some of these numbers. What stands out for you?
Yeah, I mean, I think it's more of the same from GM here, where they've really been executing with sort of the old school technology, the great big pickups and SUVs that has long been, their sort of calling card. And, we've seen sort of slow and steady progress on the electric vehicle front until recently. I think we've seen some concerns, of course, about just how much that unwind will be disruptive for the Detroit automakers, both GM and Ford. And yet I think GM was much better positioned than Ford in terms of, having the scale to where, its electric vehicle business is less of a loss-making aspect of the company. And so while we'll see some dialing back of production of those vehicles because of a sort of less receptive environment, it's going to be less dramatic than what we've seen at Ford. And meanwhile, just more and more of these, trucks and SUVs that are their specialty, the demand for those have been incredibly strong.
Craig, they just missed where the consumer was going to be. You and I have been talking about this now for a number of years. Do you think we're overstating the importance of the EV credits? I know they're material, but Craig, ultimately, was that the direction of travel anyway?
Yeah, I think, the going away of EV tax credits is a huge deal for certain manufacturers. I mean, the Teslas and Rivians and Lucids of the world that are entirely, tied to the battery electric vehicle market. This is hugely problematic for them in the U.S. And I think what we're going to see from GM is, some changes in terms of how many of these electric vehicles they make in the near term because of those credits going away, because of other forms of support, falling by the wayside. Also, just less pressure from a regulatory perspective where, fuel economy and emissions regulations have been gutted. And so, they're able to, just kind of keep ramping up that truck and SUV production. And, Americans are able to buy as many of those as they wish.
Stock is recovering now. The stock is higher in the pre-market by about 4.5%. The next hour, Craig's going to come back. Craig, appreciate your time. We'll also be catching up with, of course, Mary Barrett, the CEO of General Motors. So look out for that conversation later on this morning, 7:40 Eastern Time. You can make the argument, Annmarie, many people have, that a transition to EVs in this country specifically, was stalling long before the conversation about the expiry of EV credits began.
Right, and part of that was also just because the build out was not there in terms of where you can actually, unless you had it at your house, where you can actually recharge your car. What's so interesting for a lot of these auto executives is the fine line they have to walk, and they're getting some from the Trump administration they absolutely love. What Craig was just talking about when it comes to the fuel economy regulations and some of that being easier on these auto spaces, especially when they build these big SUVs. At the same time, if you put a ton of money into electric vehicle space, those subsidies evaporated, and there's less of a push from Washington, D.C. to continue in that space.
Stock is up this morning by 4%. Let's turn to foreign exchange. The Bloomberg dollar index falling to its lowest level in 4 years. Kit Jukes of SocGen writing, what will determine how the dollar performs will be the strength of the economy. We will have a much clearer idea of where we are headed by mid-February. Kit joins us now for more. Kit, welcome to the programme. We saw a lot of this price action in the first quarter of last year. Then the trade kind of stalled, at least for DXY. Kit, what's happening now?
I think now it's a straight fight between the sense, though, and the awareness that the U.S. economy is still doing better. Consensus growth forecasts moving higher for the U.S. And then all the noise around a president who would like a weaker dollar, a sense of that, and concerns about what policy might do, or will the equity market hold up, the kind of conversation you've just been having. And so we're in a range on euro dollar, and then we're looking at other things that, Australian dollar's very fashionable. The yen is very difficult because they would like to get it stronger. So we've got lots of noise, but the underlying theme on the dollar is one of conflicting forces. Which wins, growth or policy?
Well, Kit, let's pick up a currency pair. Let's take euro dollar. Let's discuss whether the Europeans are willing to embrace the euro strength that might come with that dollar weakness. Already one European governing council maker of the ECB, governing council member, coming out this morning and almost pushing back against the euro strength we've seen over the last 12 months or so. Can they live with euro dollar above 120?
They could live with euro dollar above 120, provided everything else behaved in the sense. So, we've been up to above 120 twice in the last few years and held there for a bit. But the difference this time is that with other currencies, things like the yuan staying cheap, the yen obviously cheap at the moment, the result of that is the trade-weighted euro is stronger than euro dollar looks, if that doesn't sound silly. And that concerns some of them. I think we could get to 120 because it's close. I think 125 is going to be a real reach. I think anything above that's impossible. I have a forecast of a peak at 120. January the 1st, I wish my forecast was lower and that we didn't think we'd get there. Today, I think I might have been right, but that's just luck and stupidity. But we're not that far. The euro is, the euro doesn't have that much growth, doesn't have an inflation problem, doesn't need a currency that gets strong. They'd be much happier if the Chinese would let theirs go up 30% and make life easier for everybody.
Well, do you think that's going to happen, Kit? Exactly. No. That's the problem. So, Kit, if you want to play this dollar weaker story, what are you playing it against in G10?
Well, that's the trouble is people who want to play it, there are two places you can play it. One is you have to believe that the U.S. is going to get a deal with the Japanese to persuade the yen to rally. And I think everybody's on board for that. But the debt sustainability concerns of the size of Japanese debt is a real problem. So it makes everyone nervous. And the other one is the high flyer of the currency world at the moment is the Australian dollar. There's a chance they get inflation numbers tomorrow that make a rate hike look really likely. And so they're moving in the other direction from everybody else. They are insulated to some degree from a lot of the geopolitics at the moment. Australia's a long way from everywhere in that sense. That would be my bet for what comes out as the winner over the next 3 to 6 months.
Well, Kit, isn't it also just gold? Individuals that were holding dollars, are they just moving potentially to put more into their gold holdings?
Gold wins everything. I'm not going to short gold. There's a correlation between gold and the Australian dollar that kind of has some sense to it, but that's not really the big driver. There's much more to the Australian economy than that. But yes, the story of the last year is that if people are unsure which currency to own, shiny stuff makes sense.
Also, we've seen the Swiss franc also be a place that people are flocking to. Is that something you think that is keen on and a good idea? It sort of at the beginning of the year it was performing badly. Then it came back in this last bit of volatility in markets. It is a safe haven. It is very expensive. It is in the middle of a tariff disagreement with the United States. They're going to suffer on some of that in the short term, and they have amassed they have intervened a lot to prevent the currency getting more expensive. The result is the National Bank in Switzerland owns a lot of U.S. tech stocks, which is an interesting outcome. But I think it can go up. Again, it can't go up as fast as gold.
Gold, that word, haven and gold. Kit, I just want to finish on that. Typically, that would mean a bout of risk aversion, but that's not what's happening, Kit. The correlation between gold and risk equities and how risk assets have outperformed has actually been really interesting to me, Kit. What do you think explains that, this regime where gold performs alongside risk?
I think it's partly it is a general sense of we don't trust fiat money in the same way, or there's people concerned about policies. It's a reflection of the massive uncertainty out there. It may also come back to your conversation of, the U.S. economic cycle is reliant on the U.S. equity market just keeping on going, and people are looking to say, is that healthy? Can it still? The valuations are high. We're feeling uncomfortable. Is the president going to make this more difficult? So there's a nervousness around there, and I think it just means that at a time of yes, rising equity prices, yes, risk on in one sense, and yes, low volatility, but historically very high uncertainty economically and geopolitically. People are trying to. They're just falling in love with a very old-fashioned solution to that problem, and it doesn't take that much buying to make the price of gold go up.
Kit, good to see you, as always. Kit Jukes there, SocGen Gold, up by 1.5% in today's session. Let's give you an update on stories worldwide with your Bloomberg Brief. Back with us, here's Yahira. Hey, Yahira.
Hi, John. Shares of GM are rising 5% in the pre-market after reporting results. For the full year 2026, GM is expecting EPS to come in between $11 and $13, exceeding Wall Street estimates. GM also approving $6 billion in share buyback. CEO Mary Barra saying we are operating in a U.S. regulatory and policy environment that is increasingly aligned. She will be joining us at 7:40 a.m. Eastern. Meanwhile, JetBlue shares are falling nearly 4% in the pre-market after reporting wider than expected losses per share for the fourth quarter. The airline forecasting capital expenditure for the first quarter of about $200 million, lower than what analysts were calling for. CapEx for the full year is estimated to come in at about $900 million. And Goldman Sachs CEO David Solomon says he sees a slower trajectory for talent growth this year, but made an upbeat call on global markets.
I think the economic setup is pretty constructive, especially in the U.S. But broadly, I think it's relatively constructive. You've got a confluence of lots of stimulative fiscal policy in developed economies. You have a general deregulatory trend and tone, both in the U.S. and Europe.
Solomon also touted the strong relationship between Goldman and the White House, saying he appreciates that the Trump administration is, quote, open for business. That's your Bloomberg Brief. John.
Yahara, thank you. Appreciate the update. David Solomon, constructive. Ted Pick, amped up. Brian Moynihan looking for GDP close to 3%. That's a pretty good outlook from the world's biggest bankers.
Definitely. And it was interesting because Stephen Angle did push back and say, didn't in August the president say you should stick to DJing? And, he quipped. He said, I like DJing. Look, this is part of the noise that you're amplifying, and you got to stick to what is working with this administration. We share ideas out in the open. We don't like something. We can be vocal about it. Sometimes it gets out in the press. That's not helpful. But when it comes to the deregulatory push from this administration, they certainly don't mind.
A great exchange with the Goldman Sachs boss over in Asia. Up next on the program, balancing the dual mandate.
Ultimately, there is this tension that the spending data have been reasonably solid, but it's the employment data that have been soft.
We'll get into that tension in just a moment with George Concalves of MUFG from New York City. You're watching Bloomberg TV. Stocks are doing okay, positive by 0.3% on the S&P 500. On the Nasdaq 100 so far this morning, up by 0.7. A big 48 hours for big tech just around the corner. Under surveillance this morning, balancing the dual mandate.
Ultimately, there is this tension that the spending data have been reasonably solid, but it's the employment data that have been soft. They're in a holding pattern given the strength in the economy, waiting for inflation to decisively start to move back down towards target.
So here's the latest this morning. The Federal Reserve kicking off its first meeting of the year, with investors expecting the central bank to pause its rate-cutting cycle. George Concalves of MUFG writing the labour market remains a critical focus. We see the Fed cutting 3 to 4 times to neutral. George joins us now for more. George, good morning.
Good morning.
Where's neutral?
Neutral is really in the eye of the beholder. And I do think it depends. And it depends on if it's a politically motivated neutral versus like an economic neutral.
Now we're getting into it. Which one is it?
Look, that's why I have 3 to 4. I have a range. I mean, I think two more cuts, I think, bring us to like a more equilibrium type rates of neutral, depending on the eye of like where you need to bring rates to anchor long-term rates, what you need to do to make housing more affordable. That's a different kind of neutral.
Well, what's the committee telling us right now?
I think the committee, this week, it's the first meeting, first skip after cutting 3 times. They've done this now 2 years in a row. I don't think that they could afford to wait that long for the next cut. And of course, we're at the end of Powell's tenure.
Can't afford to wait, so you think potentially it's on the table for this week?
Oh, not for this week. So I think look, having 9-month gap last year of cutting in September allowed for the labor market to get even weaker, unnecessarily so. And as you recall, from the Powell pivot in August from Jackson Hole all the way throughout the rationale for cutting to begin with in 2025, they pivoted towards the labor market. It's hard to pivot away from that unless you have real evidence that the jobs market is accelerating. Meanwhile, there is a path. We still have a March cut, which is obviously out of consensus and not priced in. But there's a path to cut if the February release of the January NFP and the revisions data really corroborates what Powell mentioned last year, that perhaps jobs data is overstated by 60,000 or more. And if that's true, if we hear those kind of tones this week, it'll be a dovish meeting, even though they won't cut.
It's going to be interesting because, of course, the politics is going to be center stage. When you say eye of the beholder for the neutral rate, what is the gap for the 4 candidates that may be the Fed chair in terms of neutral? Basically, Rick Reeder to Kevin Warsh.
I would say it's 50 basis points, about 50 bips. I think 2 cuts, roughly. This is why I have that kind of range of 3 to 4 cuts. Fundamentally, 2 cuts are easily justified. Beyond that, you have to start to kind of factor in other drivers.
Isn't it odd we're having this conversation with GDP tracking at 3-4%, maybe more?
It is, but the idea of running an economy hot does require lower rates, and so this is part and parcel for the objective, which is to keep the economy on fire.
This was the Seth Carpenter point. It's odd that we're seeing this jobs dynamic at the same time we're seeing GDP right up here. Does something have to give?
Well, ideally, it'd be great to see the jobs market catch up to the economy, right? But given all the other sort of new phenomenons like AI, companies holding back, you might end up with a situation where maybe productivity can fill that gap for a while, but at some point GDP is coming down. So I'm much more bearish on the outlook. I think we're peaking in activity, and perhaps we peaked already in Q4.
When you look at what's expanding in GDP, it's things like AI and then also things like gambling. So how does this economy actually have GDP expansion where it requires more labor?
Right, and that's where I think the low rate story does play a role. I mean, the small to mid-sized companies, the housing sector, those are the areas that can, with lower rates, would move the needle and actually broaden out the recovery, not just to these kind of bipolar parts of the economy.
The Fed's been a snooze for the last month. So's the US bond market. Let's get to where the real fireworks have been, Japan.
Yeah.
JGB market. I've just been surprised by how insulated the global bond market has been from developments in Tokyo. How surprised are you?
Look, I've been surprised in my wildest dreams. I would never have thought we would have the rate moves that we've seen without some sort of impact on broader sentiment and also just outright losses somewhere, right, in the system. And so there clearly is kind of this kind of balancing act that's going on. But we did look, all fairness, last week, 10-year rates did kind of gap higher in the Treasury side, right? So there was a small kind of viral infection back into the Treasury market.
Kind of for a moment, for a hot second. But I want to build on the discussion that you and I are having right now. These are the kind of things that the bears dreamt about. The blow up in a JGB market, to the extent that it has blown up. The moves we've seen in the Chinese property market over the last several years. These are the things that the bears were warning about for years and years and years. They've happened. And I've just been struck by how insulated, how resilient the global market seems to be in the face of some of these issues. Does something have to give again, or is this just the way it is?
I mean, look, I think the excess liquidity still has been working through its system, and it's been looking always for the cheapest asset, and so perhaps it overlooks these sort of kind of isolated events, which are big in and of themselves. But valuations do speak for a stretched market in all asset classes. So, like, maybe the weakest link is not where we're looking, and it's going to be somewhere else.
Where are you focused?
I still think it's the equity market. I mean, this is why the U.S. can never let equities go down. We're so linked to growth.
Can't let equities go down.
Yeah, so rates have to come down at some point.
When you look at the equity market, and do you think the bar is very high, though, for this earnings season? Cameron Dawson was talking about how the margin growth has to be 200 basis points.
Look, there's always going to be a moment where the reality is going to set in and earnings cannot actually meet the expectations. And maybe we're in the midst of that. And while you're in that transition period from high valuations, you're going to have to lean on the levers you have, which is going to be either lower rates, further fiscal spending. But we're not going to get that this year, not justifiably so at the beginning of the year. So this is why I think rates are going to play a role in keeping equities propped up.
You're convinced the future Fed chair sees it the same way?
Whoever that may be, I think is going to have to argue with keeping the equity market, well positioned to continue to grow and perform. And it's look, we're now kind of veering off into the areas where you would think it's not acceptable for U.S. capital markets or how the actual the way that the world works. But we now need lower cost of funding, higher PE valuations, and that can't change.
George, how difficult is it going to be, that new face of the Fed, though, to convince the committee?
Look, I think if it anchors back towards the fact that jobs have been lacking, and you need to have a broader growth environment, which helps out companies in the Russell 2000, as these small to mid-sized companies are the most sensitive to rates. So you can link back to the wealth effect, the kind of broadening out of risk markets, broadening out of economy. And I mean, it could be a stretch. It might take a while, but I do think that they're gonna have to get multiple cuts in before the midterms.
George, good to see you. Appreciate your time. Thank you, sir. George Goncalves there of MUFG on the race for the Federal Reserve and the prospect of interest rate cuts before the midterm elections.
Yeah, and that's music to the ears of this White House. The problem is, can that new face of the Fed, if you're already on the Federal Reserve and think that they've had an overreach in terms of the independence, and we've talked about that galvanizing some of those members, can that new individual, whether it's Kevin Hassett, Kevin Morse, Rick Reeder, maybe Governor Waller, can it convince the rest of the committee to take those rate cuts before the election?
All these concerns, the US debt load, tariffs, inflation, the JGB market, Fed independence, 10s at 4:22. Up next on the programme, Evan Brown of UBS, Henrietta Trays of Vader Partners, Bloomberg's Craig Trudell, and the GM CEO, Mary Barra. All of that still to come. The second hour of Bloomberg Surveillance just around the corner.
There is this tension that the spending data have been reasonably solid, but it's the employment data that have been soft.
Maybe that jobs market weakness is sort of starting to steady a little bit.
Inflation
while not at the Fed's target, has been heading in the right direction.
Cutting rates might be a little bit difficult to justify.
I hope the Fed stays on hold.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
The longest first month of the year ever, I think it's fair to say, for 2026 so far. This is dragging on and on and on. I was just saying at the commercial break, it feels like the end of Q2. Never mind the end of January. Live from New York City this morning. Good morning to you all for our audience worldwide. The second hour of Bloomberg Surveillance starts right now. Your price action looks like this. Equity futures on the S&P up by about 1/3 on the Nasdaq up by 0.7 through the close yesterday, within striking distance of all-time highs, within 0.5% of a record on the S&P 500. Big week still to come. Tons of tech earnings just around the corner. A big 48 hours for big tech. We will get numbers from Meta and Microsoft. Apple coming on Thursday, and a Fed decision in the mix just around the corner.
And the Fed decision is going to be really interesting. We're just talking to George there, who says they're going to have to cut before the midterm elections. He has an out of consensus view that maybe March is going to be on the table. No one thinks they're going to cut this week, but this week is going to be important to understand where the Fed is really emphasizing their mandate right now. Is it still concerned about the labor market, and also the politics surrounding Jay Powell is going to be center stage, or what do you say, pay-per-view?
Box office, pay-per-view. I mean, take your pick. Look, the chairman has backed off from engaging in this subject for the best part of 12 months until recently, where he became more assertive, I would say maybe even more aggressive. Is he going to take that posture into the news conference tomorrow?
I was talking to Mike McKee about this before the show. He was walking in with his luggage because, of course, he'll be going down there. Flights operating, of course, so the Fed getting back to business in D.C. The issue is, to your point, he's ignored it for months. The problem is now he has, in the administration's eyes, made it political by showing up to the Supreme Court hearing for Lisa Cook. And he might flirt with the idea of saying something more than just no, or I refer you to the Justice Department, I refer you to the White House on these questions. He might flirt with it a little bit more, but to Mike's point, he doesn't want it to dominate the entire conference. So a little bit of a balance he's going to have to strike.
Mike McKee, of course, will ask those questions in the news conference, no doubt, tomorrow afternoon. If you're just joining us, equity futures positive by about 0.3% on the S&P 500. Coming up this hour, we'll catch up with Evan Brown of UBS as equities build on a 4-day winning streak. Henrietta Trays of Veda Partners as a government shutdown deadline looms. And the GM boss, Mary Barra, is going to join us as the carmaker reports an earnings beat. We begin this hour with stocks edging higher as the Fed's 2-day meeting begins. Evan Brown of UBS writing, risk the consensus growth forecasts are skewed to the upside. Solid growth with contained inflation favours equities and credit. Evan joins us now for more. Evan, good morning.
Good morning.
Let's
Thanks,
take the first line first. Skewed to the upside, why?
Well, we've got the fiscal support coming through, over $100 billion, that's going to hit the consumers' wallets here in the U.S. We have also a positive fiscal impulse in Germany and Japan. And so all of that together is pretty supportive of growth in the first half.
Better growth, contained inflation.
Yes.
How does one not lead to an inflation boost?
Yeah, so we have this downtrend in shelter, which is a huge part of inflation. We also have wages, which are also weighing on inflation. I do think, we've had this disconnect, we're all talking about it, between growth and the labor market. Maybe there's an AI story there, maybe it's just general business caution, but the reality is that the labor market is not tight, and so you're not going to get this immediate acceleration in wages that's going to increase domestically generated inflation.
Does that give this Fed even more space to reduce interest rates?
It does, in our view. I mean, we think that the Fed can cut rates a few times this year. It's going to become clearer and clearer as the tariff effects come out of inflation that they'll see enough there to cut rates.
When it comes to the labor market, though, if part of it is AI-induced, how does a Fed rate cut solve that?
I don't know if the Fed really needs to solve that. I mean, there are certain areas of the economy that remain weak, like the housing market, and hopefully Fed rate cuts can provide some support there. But I think in general, for the kind of the areas of the economy that are weakening because interest rates have been too high, the Fed will help. I don't think it's going to do much in terms of the AI front either way.
How concerned are you mentioned tariffs before this, about the impact just happening now? You had the Amazon CEO last week talking about he's starting to see the creepiness of tariffs come in. They're creeping into some of the price levels that they weren't happening last year.
Yeah, so we are going to see a little bit more of a push through in goods inflation from the tariffs. But what we take a lot of signal in is 1 year inflation swaps, essentially what the market is thinking inflation is going to be a year from now. And those are absolutely collapsing. So there may be these temporary effects from goods prices going higher because of the tariffs, but once that washes out, you've got these domestic effects that are putting downward pressure on inflation.
Let's turn to the market moves. Gold's ripping. The dollar's selling off. We saw a bit of this last year. We're seeing it again at the start of this year. What do you think is the dominant driver behind that move?
Yeah, I think in general there's a few things. One is that there's growing concern about fiscal deficits, not just here, but in Japan and in other places. In gold, I mean, we have seen a surge in geopolitical volatility. And so, there's this knee-jerk move into gold as well. For the broad dollar, yes, we're beginning to see some weakness this year. And I think that some of that is related to the Treasury via the Fed checking rates on Friday and essentially sending a message. We want to limit dollar strength from here. As much as we see the U.S. economy accelerating, we don't want to see the dollar going with it.
So last year, when we saw this big bout of dollar weakness, it was accompanied with rest of the world equity outperformance. Do you see it the same way this year?
Yeah, I think combined, we do see further dollar depreciation over the course of the year, and the Treasury stance on the dollar is an element there, as well as interest rates coming down relatively more in the U.S. than elsewhere. But I also just think that the U.S. equities in general, we're having to be a little bit more selective, right? It's no longer this one big AI trade that's driving the index. There's a lot more differentiation in that space. Whereas globally, you see some really powerful themes, whether it's high bandwidth memory in Korea, or just the broader reflation trade in Japan, or defense and industrials and banks in Europe. So all of these themes, I think, are going to attract capital over the course of the year.
When it comes to the idea of the sell America trade, is it just sell the dollar but still make sure you're exposed to the equity market?
Yeah, it's interesting because we have a lot of conversations with large global allocators, and they're not saying, hey, we want to sell our underlying U.S. assets. They're not saying, hey, we want less exposure to U.S. equities. But what they are saying is, hey, we built up a lot of dollar exposure. We see that the administration is looking to get a weaker dollar, and maybe we should be hedging a little bit more of this exposure.
So when they hedge that exposure, where exactly are they looking to?
In general, they're just selling dollars forward and buying back their own currencies, essentially. And so, again, no reallocation out of U.S. equities, but selling the dollar to hedge that flow.
You mentioned South Korea. The move on the Kospi so far, I think year to date we're up by 20%.
Yes.
Best performing currency in G10 this year, the Aussie dollar. The moves you're starting to see now, copper exploding as well over the last several months, base metals. If you just showed me that and didn't tell me anything about the news flow, I'd be like, well, Evan, this is just telling me we're going to see a massive, massive pickup in global growth. Is that what that is? And do you expect to see that?
I think it's two things. One, a cyclical acceleration, some pickup in global demand driven by fiscal policy. But I think there's other element here, which is a strategic move by the U.S., China, and other countries to really build up minerals. That there's this kind of strategic de-risking.
Like an arms race.
Yeah, essentially, with China weaponizing rare earths, the U.S. and other countries realizing, hey, we need to make sure that we have these materials, copper and such that our supply chains are in good shape. And so that global stockpiling and that global investment, I think, is supporting the metals and supporting countries like Australia that really export these materials.
Do you see all of this as a multi-year secular force that you just have to get behind? And to what extent should I just ignore traditional macro indicators like GDP, payrolls growth, when this is where things are heading? This is where governments and policymakers are pushing.
Yeah, I mean, I don't think you ignore the cyclical impulse. Like, if we were to have a recession, then these metals are going to take a hit. But I do think that there is going to be this strategic underpinning driven by geopolitical themes that is going to support these metals and these critical minerals going forward.
Are you spending more time talking about that than, say, the unemployment rate in America at the moment?
Yeah, I mean, we remain focused on the labor markets. It's key ultimately to what the Fed does and everything. But ultimately, I think you want to take these signals from the markets seriously. And when you see the kind of moves that we're seeing in copper or in the companies that are refining and exporting rare earths, like that's something to pay attention to.
You certainly take note. Evan, it's good to see you. Thank you, sir. Evan Brown of UBS. Tariff threats on South Korea. The Kospi's up this year by more than 20%.
Well, I think a lot of people are just looking through and thinking this is going to be Trump will chicken out or force the South Koreans to just expedite this investment deal they have with the United States. But to his point about what's going on with China, this administration couldn't have been clearer. Whether it's taking equity stakes in companies or whether it's talking about places like Greenland, it's the critical minerals they want access to and then the ability to process them right here in the United States.
Equity futures this morning positive by about 0.25% on the S&P. With an update on stories worldwide with your Bloomberg brief. Joining us now is Yahara Arnott. Hey, Yahara.
Hi, John. Airlines in focus this morning as earnings season rolls on. American Airlines shares up 2.2% after missing on fourth quarter results and posting weaker than expected EPS guidance for the full year. Meanwhile, JetBlue shares are falling 4% after reporting wider than expected losses per share for the fourth quarter. Meanwhile, the European Union and India concluded a free trade agreement after almost 2 decades of negotiations. It's part of an effort to deepen economic ties ramped up by aggressive tariff policies of the Trump administration. The deal includes reducing tariffs on imports of EU-made cars to 10% from as high as 110%. And here, the largest U.S. grid operator has been granted authority to divert power destined for data centers to households, hospitals, and other customers. The move aims to prevent rolling blackouts as an extreme cold snap strains electricity supplies. The order was authorized by U.S. Energy Secretary Chris Wright on Monday. That's your Bloomberg Brief. John.
Yahara, thank you. More from Yahara later this hour. Up next on the program, working to avoid a shutdown.
The White House supports the bipartisan work that was done to advance the bipartisan appropriations package. We absolutely do not want to see that funding lapse, and we want the Senate to move forward with passing the bipartisan appropriations package that was negotiated on a bipartisan basis.
Up next on the program, Henrietta Trace of Veda Partners, live from New York City this morning. Good morning. Stocks are doing okay, up by 0.25% on the S&P 500, going into a big 48 hours for big tech. The Nasdaq is higher by 0.65%. Down in Washington, under surveillance this morning, working to avoid a shutdown.
President Trump does not want any Americans to lose their lives in the streets of America and in American communities across the country. The White House supports the bipartisan work that was done to advance the bipartisan appropriations package. We absolutely do not want to see that funding lapse, and we want the Senate to move forward with passing the bipartisan appropriations package that was negotiated on a bipartisan basis.
So here's the latest this morning. Negotiations underway to avert a partial government shutdown. Senate Democrats pushing back against funding the Department of Homeland Security without new safeguards. Bloomberg's Tyler Kendall joins us now from Washington for more. Tyler, the buzzword there, obviously bipartisan. How bipartisan is the effort down in Washington?
Yeah. Hey, John. Good morning. Well, the spending package that is in front of the Senate was struck on a bipartisan basis and does include some hard-fought wins for Democrats, including a reversal to cuts that the Trump administration did when it came to foreign aid or medical research, for example. But when it comes to a way forward at the moment, it doesn't really seem like we are getting really a long, elusive off-ramp here, because while Republicans do say that they are willing to negotiate, the only options that have been put on the table as of now are non-legislative options. They're pointing to President Trump's de-escalatory efforts, such as pulling out the Border Patrol chief. But Democrats say that they want to see some real curbs tacked onto ICE that is in legislation, not just executive action. They are looking for things such as warrants and warrant requirements, also mandatory body cameras that could be included in actual written legislation. And at the moment, it's not clear if that's really going to happen. Perhaps we'll see some sort of separate legislative vehicle emerge, but at the moment, that would really take away Democrats' leverage because they want to see changes to this package, which is linked to the potential for a partial government shutdown. But we have to say that there are some big political risks, including for Democrats here, because if they just strip out DHS funding, that probably wouldn't impact ICE, since we know that the agency did get a big windfall when it came to the One Big Beautiful Bill. So, John, at this moment, we are watching this closely, but unless a solution emerges that both sides can get on board with, because Republicans need at least 7 Democrats to pass something, it looks like we are careening towards Friday's deadline.
This does feel different, though, Tyler, than what we saw in the fall with the record-setting government shutdown, where I feel like party lines are really hardened. We are seeing Republicans from the onset say we're looking for an off-ramp. How much time do they have, though, to get to that off-ramp?
Well, they really only have until this Friday at midnight, Annmarie, because that is the government shutdown deadline. But you're exactly right. This is different because Republicans are saying that they're willing to negotiate. But as of now, the only things on the table are non-legislative action. So we're going to have to see how that ultimately revolves. The other big issue here when it comes to deadlines is that any changes to the proposed funding package that is in front of the Senate is going to have to get kicked back down to the House. And the thing is, the House right now is on recess. They're not even here in Washington, and they won't be until February 2nd. Tie in the weather complications, and that is only going to make this even more difficult to ultimately get passed. That is why we are watching closely whether or not some sort of separate legislation could ultimately emerge that Democrats could get behind. But at the moment, they are holding firm that they need to see specific changes when it comes to this package. Though, Annmarie, we can say this would be a partial government shutdown. They've already passed 6 out of the 12 required appropriation bills, and they are proposing that they could pass 5 more, just leave out DHS. But again, that opens up a whole slew of issues, including that they need the House to do so.
Tyler Kendall with the latest down in Washington. Tyler, thank you. To build on this conversation, Henrietta Trays of Vader Partners writing, at this point, a partial shutdown of the federal government on January 31 appears highly likely. However, there is bipartisan support for limiting the shutdown to just the Department of Homeland Security. Henrietta joins us now for more. Henrietta, welcome to the program. Immigration enforcement. The president won the argument. He won the election. Is he now losing the country?
Yeah, I think that's pretty clear. And you have a whole bunch of Republicans, especially those that are in very at-risk states, coming out clearly condemning the moves from ICE that resulted in the death of Alex Preedy over the weekend. And that kind of disruption and the fracture in the Republican Party is how you know that things need to change from the status quo that we have right now. I think, in addition, the personnel swaps that the White House is trying to do in Minnesota are just not sufficient. I was speaking with some Minnesotans last night, and they don't see a difference between Bovino and Homan. So they need to see quite a bit more out of the White House than what is currently on the table. The solution is actually pretty simple. From a Senate procedural process and from a House process, it's, maybe technically difficult. You got to get those members back, as Tyler was just mentioning. But you strip out the DHS funding from the underlying package of bills, get unanimous consent in the Senate to do that, move ahead, and you avoid a shutdown of the Defense Department, a shutdown of the Labor Department, and we proceed to, just focus on ICE.
Henrietta, just 2 weeks ago, you had an odds of a government shutdown at 25%. Now they skyrocketed. So you think now, what is the percentage that we will shut down on Friday, and how long will the shutdown be? Because remember, we just got over, in the fall, the longest ever government shutdown.
I hear a lot of optimism behind the scenes from Democrats and Republicans that the path forward, as I just mentioned, is pretty simple. You just strip out DHS funding. And the problems for the White House is really optics. They have to sort of admit that there was a catastrophe in Minnesota and there needs to be remedies here and restrictions put on ICE. The White House is tacitly acknowledging that already with the personnel moves. But my base case expectation is that they do find an off-ramp here. Neither Republicans nor Democrats want this shutdown to happen, which is very different than the October 1st shutdown that we saw last year.
Well, the president also called Governor Walz yesterday and the mayor of Minnesota. Does that bode well for the White House or for Democrats? He's the one making that outreach.
I think this is a case where the American public is demanding change and both sides are prepared to give a little bit. Whether that's going to be sufficient to get you changed to a piece of legislation on the floor remains to be seen. But every side is recognizing that the killings have to stop. And it's so overwhelming in public polling that it's just obvious. You need to put your partisanship aside. You can't be talking about the Second Amendment. You can't be talking about ICE like it's okay right now. You got to move forward from both sides.
So if we have this off-ramp with the DHS funding stripped out, what do Democrats need to see to then sign up for DHS funding? Because Majority Leader Thune's going to need them to pass that through at the end of the day.
Yeah, absolutely. I think that Democrats are still pulling together a concrete list of what they want. There were some conference calls throughout the day yesterday. I think the most extreme is probably for DHS head Kristi Noem to resign. And that's definitely going to be something that stays on the front burner. She's actually scheduled to testify on March 3rd, if I'm not mistaken. So her time in the spotlight hasn't really even begun yet. And I think that's going to be a major point of focus for the Democrats. And it's a convenient out for a lot of the Republicans who want to see some real visible change to the immigration policies that are really dragging the president down right now with the American public.
I'm glad you brought that up. Do you think she is going to make it to that hearing? Because we have had Senator Tillis block all these DHS appointees until she decided to come on the Hill for a hearing, and they've been dragging that out.
Yeah, they really have. And March 3rd is a really long time away. Think about what's going to come in between them. The president has to deliver a State of the Union address. Immigration is going to have to be in the forefront. Hopefully there's no other escalation and ICE really steps back from its very aggressive sort of patrolling of the streets right now. You have a lot to do before we get to March 3rd. I think the question of whether she makes it that long is a really good one. I don't know, but it's not a guarantee.
Well, speaking of the senator from North Carolina, he's got a big role to play in the process to nominate and confirm the next Fed chair. Henrietta, I thought this was going to happen months and months ago. What's happening?
I've said this to clients quite a bit. If you think in the grand scheme of things of what's going on in D.C., from trying to annex Greenland to raising tariffs on South Korea to the killings in Minnesota, the Fed parlor game is actually the least insane or really scary or problematic part of the administration's focus right now. They don't need a predecessor for Jay Powell until May. So they can drag this out. It's already been, a couple months past due. Secretary Bessent said, it was coming at Davos. I think they got time, and I don't think it's a high-stakes thing. Obviously, the street is very closely watching it, but it's really just a parlor game between a couple of options that the street is pretty comfortable with. So as long as, even if there is a new hat thrown into the ring, like Secretary Bessent as a potential nominee, I don't think that that's comparatively a problem for the street, and the White House is happy to have that parlor game go on for a while longer.
You'll forgive the Wall Street bias, Henrietta. It's all we care about on any given day. You know that.
No.
It's good to see you. Henrietta Trays of Vader Partners. For the country, there are much, much bigger issues right now here on Wall Street. If you're tracking that story, you're going to have to wait, basically listening to Henrietta, and I don't get the impression that the president has made the decision just yet on who that person is.
No, we didn't get it at Davos. I mean, I know the Treasury Secretary said maybe we'll get it the week after Davos. It doesn't feel like it is an urgent matter at this moment for this White House. Who knows? The president's speaking tonight. He does like to revamp a little bit. Potentially he talks about the Fed chair race, but to Henrietta's point also, this parlor game, she's making it out to be like it's really not a big deal who he chooses. The problem is the process in the Senate and how quickly this could get done. To Senator Tillis's point, he's not doing it till the DOJ probe is wrapped up or 347 days, whatever is left until he retires.
He said it's the process. It's not the individual, the process, not the individual, and this could take a whole lot longer. If you're just joining us, equities are positive by about 0.25% on the S&P. Coming up on the programme, we'll catch up with the General Motors chair and CEO, Mary Barra, with an upside earnings surprise earlier on this morning. Plus, Danny has some of your morning movers. UPS rising after a strong sales forecast. That stock up in the pre-market by more than 3%. From New York City, you're watching Bloomberg TV. Big 24, 48 hours coming up for big tech. Stateside earnings coming up tomorrow from Meta and Microsoft. Thursday we'll get results from Apple. Look out for all of that. Equity futures right now in the S&P up by about 0.2% on the S&P 500 after a 4-day run with no losses. The longest stretch of the year so far for the S&P 500. Notable that the small caps had their first back-to-back losses on the Russell for 2026. Let's see if we can get some performance back from that big trade that's been picking up over the last month or so. The Russell this morning up by about 0.1%. In the bond market, can move on very quickly. We hit snooze so fast in fixed income stateside. 10-year bond yields up just a single basis point, 422.53. And going into the Federal Reserve decision tomorrow as the two-day meeting begins, twos anchored around somewhere between 350 to 360 with no rate cuts in sight for this meeting, at least 359.14 according to so many of you. Where are the fun and games? Where are the fireworks? Here they are right here. Gold, 7 consecutive days of record-breaking gains. Gold this morning up by 1.4%. Gold at all-time highs.
This is where everyone's hiding out. There's so many. This is part of the debasement trade. This is part of geopolitical uncertainty. This is part of heightened central bank buying when it comes to gold, and not even those countries that are trying to evade sanctions, but others like Poland doubling down and making sure they're going after gold. I read from an individual this morning from RBC's Wealth Management talking about they could see $7K a troy ounce on gold by the end of this year. Do you know what I keep asking? And I'm sure individuals in the administration would say I'm just a conspiracy theorist. I wonder if this administration is finally going to remark gold.
You've been asking this over and over again for the last year or so.
Gold keeps rip-roaring. It's on a tear. It is smashing record after record. You see these banks coming out, Goldman, Bank of America, they keep having to move the goalpost when it comes to gold. And it is off to the races for this precious metal. At the same time, when you look at our balance sheet, it's $45 and change. And this is an administration that is obsessed with finding money anywhere to bring down the deficit. Well, billions of dollars potentially with just adding a few zeros on the balance sheet.
Gold this morning up by 1.5%. If you're listening, Mr. Secretary over at the Treasury, I think Annmarie's got a message for you. Year to date, gold is higher by close to 18%. That's child's play. Silver, some massive volatility there in the last 24 hours. Silver so far, tracking this one, up by more than 7% on the year. We're up by something like 55, I think. Just a massive rip-roaring rally for that particular precious metal. As we count you down to the opening bell, about 2 hours away, let's get you some morning moves and cross over to Danny for more. Hey, Danny.
Hey, John, I got all earnings for you this morning. GM reporting in the last hour, seeing profit coming in at $2 billion, exceeding expectation. Also a healthy buyback being given. And again, just shareholder distributions. I know Matt Miller is going to be speaking to the CEO very shortly, so those shares up 4.5%. UPS also reported this morning a full year forecast that exceeded expectations. Actually the first time UPS has even given a full year outlook in a year. So positivity there. They're also cutting businesses that are less profitable. Shares go up 3.7%. Finally, have a look at some of the airlines that reported today. We heard both from American and JetBlue. This one is interesting because American missed on their expectations. They also said that the storm was going to hit them, but investors finding something they liked out of that. Shares up 2.8%. JetBlue, the losses will be wider than expected. The struggles continue there, and shares are down 3.5% in the pre-market, John.
Hey, Danny, appreciate the update. Danny Berger there with the stock movers this morning. More from Danny in the next hour. On our radar this morning, the European Union and India reaching a free trade agreement in the hopes of offsetting Washington's tariff policies. The deal aims to reduce or eliminate some levies between the nations and double EU exports to India by 2032. Elsewhere, the Energy Secretary Chris Wright granted the largest US grid operator authority to divert power from data centers to households. PJM Interconnection can now order large facilities to switch to backup generators in order to reduce their burden on the grid. And finally, American Airlines reporting a miss on its fourth quarter earnings and weaker than expected EPS guidance for the full year. Elsewhere, JetBlue with wider than expected losses per share as it struggles to win over high-paying customers. American Airlines is higher in the pre-market. JetBlue is down by 3.5%.
This is all about making sure you can win over those individuals that are flying, as we've always talked about, in the front of the cabin. You have to wonder as well. These airlines are the ones that are suffering as well with this winter storm. They were suffering when there was a government shutdown. Potentially, we're going to have another government shutdown. And this just makes it an incredibly challenging environment. again.
JetBlue trading lower in early trading. More on that story in the next hour or so. Let's get back to those auto earnings. Bloomberg's Matt Miller joins us now with a very special guest. Good morning, Matt.
Good morning, John. Yeah, I have Mary Barra here, the CEO and chair at General Motors, I'm pleased to say. And Mary, really knocking the cover off the ball with these earnings. You see with your outlook more than $2 billion in extra profit and a profit jump for 2026. Let me start by asking what you attribute this to. Is it just the great sales and the financing of the higher margin vehicles like a Sierra, like an Escalade?
Well, first, I have to start by thanking the entire General Motors team, our suppliers and our dealers for doing a phenomenal job. 2025 was an exceptional year, especially when you look at all the challenges that we face. And I think it really demonstrates one of the core capabilities of GM, and it's our agility and our resilience. But the core of it starts with our great product portfolio, whether it's very affordable EVs like the Chevrolet Trax, all the way up to, a supercar like what's behind me with the Corvette ZR1X. So couldn't be more proud of the team.
The ZR1X with 1,250 horsepower. It is indeed, I would call it a hypercar, Mary. That's not the bread and butter, though, for you. You really make these highly profitable, highly capable big trucks, and Americans are buying more of those and fewer of the EVs. Do you expect to continue to sell fewer of the EVs? I know you took a $7 billion and change write-down for that business in 2025.
Well, the whole industry, we were on a path that we were working to get to 40 to 50% EVs by 2030. So now that the regulatory environment has changed and the consumer incentives have gone, there is going to be slower EV adoption. We're still committed to EVs, and we've got a great portfolio that we're working on taking costs out of. But in the meantime, we also have a great internal combustion engine platform. And you're right, full-size trucks are one of the strengths we have, as well as full-size SUVs, mid-size crossovers. So we really have a strong lineup across the board, and that is really what is, fueling our business success.
I have had, as the host of Hot Pursuit, a Bloomberg podcast about cars, the opportunity to drive a lot of your EVs, from the Sierra EV to the Hummer EV to the Escalade IQ, and they're fantastic products. Are you not deterred that Americans aren't buying more of these vehicles? You know how capable they are. You know how useful they are in daily life. What needs to happen for more Americans to buy these EVs?
Well, I think the consumer is very rational when they're making a decision about what car to buy. Let's remember, it's one of the most important and expensive decisions that they make. And one of the things we have to continue to work on to drive EV adoption is a more robust charging infrastructure. And that still is continuing to happen. So every quarter, more and more chargers are available. I think as people in their individual communities see that they've got a robust charging network and believe if they have to go on a road trip, there's that as well, they're going to make that choice. And what we do see is once someone buys an EV, they see the technology, they see the driving experience, never having to go to the gas station, and they stick with EVs. So I think it will happen over time, and that's why during this period we've already got a great portfolio of EVs. We're going to continue to take cost out to get our EV portfolio profitable, and we're going to be well positioned as EV demand grows over the next handful of years.
What about the hybrids, Mary? I mean, GM was really a front runner, not only in EV technology, but in hybrid technology with the Chevy Volt. I remember when the Tahoe came out with a 6-liter gas engine and electric battery power. Will you start to sell more of the hybrid vehicles?
Well, we have always focused. As you said, we have great hybrid technology. We have great EV technology. We're one of the few OEMs that invested in a dedicated EV platform that allows us to have the portfolio we have. So we're focused on the end game, and we have affordable EVs. So I think that's where our primary focus is. We understand the technology. We have it in other regions. You'll see us with a handful of hybrids as we move forward. But right now, our focus is really on having the right internal combustion engine portfolio and the right EV portfolio moving forward. And I think we're demonstrating that that's a winning formula, because over the last 4 years, we've gained share each year.
I wonder how much your racing efforts push towards that. And I know this is something I've talked about with your president, Mark Royce, on a number of occasions, but you're getting into so many more leagues. I watched the hypercars in Le Mans this summer, and looking forward to watching you participate in Formula One. Do you think this really boosts your brand awareness around the world?
Absolutely. We definitely see that it does. And I think, when you look at Cadillac and the strength of Cadillac, it is true luxury, true American luxury. F1 is the place that Cadillac should be showcased. So we're very proud to be a full works American team, anxious to enter this year in Australia. But I think it's going to be very important for the Cadillac brand. And we do have a really robust program that takes what we learn on the track and we incorporate it into our vehicles to make our vehicles better. It's true for Chevrolet as well as Cadillac and the entire portfolio.
I got to ask about the finance arm. GM Financial provided a massive liquidity buffer, I think $36 billion there. How do you think about, because you're doing buybacks, returning a lot of cash to shareholders, I'm sure they're happy about, the stock is near an all-time high, but how do you think about putting that aside for protection versus supporting shareholder returns, in case the auto cycle turns at some point?
Well, we've indicated that 18 to 20 billion is our cash target. Last year, we finished the year strong at around 22 billion. And we have a capital allocation framework of first reinvesting in the business, second, making sure that we have an investment grade balance sheet, and then returning cash to shareholders. And we think based on the strength of our business and the cash that we generate, we can continue to do that well. And that's where our focus is.
The financial arm has added, I think, more than $2 billion to 2025 profits. So it's really a contributor, kind of a quiet profit stabilizer. Is that turning, though, as delinquencies and charge-offs rise a little bit? Is that starting to concern you as consumer balance sheets thin out?
Well, it's something that we watch very closely, that I think GMF does a great job in their business, and it is a very important business. Shout out to the GM Financial team for the great work they do. It's also very important from a loyalty perspective, because having a captive and being able to interface with the consumer on a monthly basis as they make their car payments, I think is just part of the ecosystem that we're building to really make sure we have that great relationship with the customer, and it shows that we have the highest loyalty in the U.S. of any OEM.
I look at loan originations in the fourth quarter, and I see that they're down pretty substantially, about 21%. And I wonder if that's a deliberate choice by GMF. Are you tightening your credit standards, or is that reflecting a softer demand at today's rates and prices, which are both fairly high?
Well, the car company and the finance company, they work together to make sure we have the right equation and what's going to optimize, profitability for the enterprise. And so I don't think you can look at one quarter. It goes up and down depending on what's happening in the external world. But GMF is a very important part of our portfolio of companies. And again, as I said, it works in concert with the car company to make sure that we have a strong business overall.
I have to, when I think of credit standards, I think of First Brands among some of the other businesses that have fallen to Chapter 11 this year. And I saw a report in the Financial Times overnight that you, along with Ford, your crosstown rivals, are negotiating to help send them a rescue line of sorts. Can you comment on that at all, Mary?
Well, what we're very much focused on is, while we make sure we have secure supply, is that transition period. So I think what you see General Motors and other OEMs working together to do is make sure that we don't have supply chain disruptions because of their financial situation. We've been working on it, but I think as we look at the immediate, what's happening next week, next month, that's the work that we're doing, as well as in parallel making sure we have longer term supply. So that's what you're seeing with that announcement.
When you talk about the supply chain, I think about the concessions you're able to get out of your suppliers. I know that you're trying to keep costs down. You're under a threat of tariffs, or you already face tariffs in a lot of the places you produce. How much of those tariffs have you been able to pass through to consumers where you haven't been able to cut costs or get concessions from suppliers?
I think if you look at our portfolio, I think, for the most part, we've worked to offset it and with efficiencies across the board, making smart decisions on where we produce. And so very little has gone to the consumer because we are such a cost-sensitive business, and it's such a competitive business. But we continue to look at all of those levers, and we stay focused on consumer affordability.
You're operating, Mary, in the heart of America, and America has undergone some really tough times, especially over the last few weeks in Minnesota. What are you doing? What is General Motors doing to kind of keep the temperature down, to kind of keep the calm at your company and with your suppliers?
Well, we want to make sure that everyone stays focused on the business and is part of the solution, meaning de-escalating. I believe that's starting to happen. So that's what we continue to reinforce.
All right, Mary, thanks so much for the time. Really appreciate it. And I look forward to talking to you again. Mary Barra there, the CEO and chair at General Motors. John?
Hey, Matt. Thank you, buddy. Great work as always. Matt Miller there on General Motors. That stock up in the pre-market by more than 4%. If you're just joining us, welcome to the program. Decent outlook for them. GM reporting an outlook for 2026, adjusted EPS in a range of $11 to $13. The estimate was $11.79. That's helping to push the stock higher. Also approving a new $6 billion share repurchase authorization.
Interesting discussion there that Matt just had with Mary Barra when it comes to also where the consumer is going. Jonathan, you've been talking about this for months. She talked about GM will go to have a handful of hybrids. That's where the consumer is going because there is still that consternation when you're buying a car. Will there be an EV charging station if I want to take this car on a long trip, which is why individuals want the hybrids. And right now, Mary Barra was saying the issue with the EV space right now is not the car, and Matt knows this because he's driven a lot of them. It's actually the infrastructure that the car needs in order to take it out.
Just to be clear, Matt was not in a GM last time I saw Matt. I was with Matt in the car yesterday. It was an Aston Martin SUV.
Ooh, Matt.
Not bad.
He has, I did go in a Porsche 911 with him before.
He told me he was test driving it and he's not buying it, but, Matt has a different kind of taste.
Is he your new driver around Manhattan?
Vehicles.
Because, these roads are very difficult. Matt is a good driver.
Miller handled these roads very, very well, I can confirm. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Back with us, here's Yahira. Hey, Yahira.
Hi, John. Turning to other earnings, we're seeing Boeing shares falling 0.5% in the pre-market despite reporting adjusted free cash flow for the fourth quarter that beat the average analyst estimates. Boeing highlighting that their 737 program lifted its production rate to 42 a month as it makes progress under CEO Kelly Ortberg following years of operational and quality issues. Meanwhile, Microsoft is rolling out a new AI chip as it pushes to provide an alternative to NVIDIA hardware. The chip will power Copilot for businesses and the latest OpenAI models on Microsoft's cloud. The company says the chip, the Maya 200, beats comparable chips from Google and Amazon on some tasks and is its most efficient system yet. And FIFA's former president is advising football fans to stay away from America and this year's World Cup. The U.S. is co-hosting the tournament with Canada and Mexico for about 5 weeks starting in June. Calls to consider a boycott are getting louder amid President Trump's immigration crackdown and a fraying relationship with Europe. We shall see. That's your Bloomberg Brief. John?
Yahira, thank you. Just want to remind everyone where the 2018 World Cup took place. And no one seemed to have a problem with that. Russia.
Well,
a few years after going after
I spoke
Crimea.
to a lot of people that
and
went
European
to that.
nations all went to that.
Yeah,
World Cup.
I did speak to a lot of people that did go to that World Cup, and they said it was incredibly easy. The Russian government put out the red carpet for anyone who wanted to come and was encouraging it. A lot of people thought this is the one time.
That's the point I'm trying to make here, Annmarie.
Oh no, I'm just saying that they made it easy for people to come, where the United States, when they have visa bans on some of these countries, is projecting potentially might be a problem. But yes, what you're talking about is signaling that seems off, because individuals were flocking to Russia after they invaded Ukraine, and look where we are today with that country.
Futures this morning positive by 0.25% on the S&P. Up next, an earnings recap and another look at the markets from New York City. You're watching Bloomberg TV. Live from New York City this morning. Good morning. Welcome back to the program. Let's check out the equity market first. Equity futures positive by 0.2% on the S&P. On the Nasdaq 100, we're higher by 0.6%. This from the FX market just moments ago. The Bloomberg dollar index dropping to the lowest, the weakest level since February 2022. It's down by about 1/3 so far this morning. That's the move in foreign exchange. Renewed dollar weakness and gold out to fresh all-time highs. That's the price action. Let's get you a single name. GM shares rising after an earnings beat. We just caught up with Mary Barra of General Motors moments ago, and joining us now is Bloomberg's Craig Trudell. Craig, General Motors seems to be in a better place. Walk me through the auto market first, and then we can talk to which companies are best positioned.
Yeah, I think the U.S. auto market has proven to be quite resilient. There were a lot of sort of, bumpy moments last year, I would say, especially around, sort of Liberation Day and all the concerns about tariffs. And I think what we saw is, broadly speaking, the industry, making some moves around the margins to shift some production, doing some eating of tariffs, but they were able to afford doing that because we still have Americans buying, on the order of 16 million cars every year, and also buying a lot of, very expensive vehicles. I think we saw that especially toward the end of the year where, the average new car sold in the U.S. went for more than $50,000. And, this is just something that we've seen sort of, steady rise in vehicle prices that has really boosted these companies.
When you look at their gross tariff costs, though, they said it was about $3 to $4 billion. Mary Barra was very careful talking about tariffs, saying they made efficient, smart decisions and little are going to the consumer. But, Craig, when you look at the year ahead, do you think more potentially could be passed through to the consumer?
I think there's a possibility of that. I think, you have, some flexibility if you're GM to sort of, move production around or to rely more on your U.S. plants and sort of less on your Canadian and Mexico factories. But, you can only do so much there. And I think, the willingness on the part of these manufacturers to sort of eat that has, probably reached a point of, needing to make some adjustments. We also probably have seen some changes more on the margins where rather than sort of risking the ire of this administration and out increasing MSRPs, you can sort of change, your sort of allocation of builds and only make sort of higher end trims, those sorts of things. So there's probably more to this in terms of complications than meets the eye.
Matt was asking her about the EV business because, of course, the subsidies have gone away. And she basically said it's not the car, it's the infrastructure around the car. Is that Mary Barra basically saying GM is not abandoning EVs, but it's just going to be a lot slower?
Yeah, we've heard her say before that, EVs are still GM's North Star. And I think, that is an interesting sort of statement coming from her, given, the diversion that was sort of, thrown in last year, right, where U.S. policy went from, very pro-EV with $7,500 tax credits for EV purchases. The Inflation Reduction Act had all sorts of measures to try and, localize EV and battery production. A lot of that was just absolutely, sort of the rug was pulled last year. And that really complicates things for GM if indeed this is, the sort of end state for them, because they are going to have challenges with, being able to justify, keeping some of the production capacity that they built up over the last few years. And you've already seen them make some adjustments to bring that back down and get it more in line with where the consumer is, which is, not quite ready to go fully electric and, more willing to go the hybrid route where you're not having to necessarily plug in the vehicle and rely on public charging in particular.
GM this morning higher by 3.9%, higher by close to 4%. Craig, good to see you, sir. Craig Trudell. These companies do a phenomenal job of navigating really, really difficult issues in both China and in the US. Tough competition in China, policy volatility in the US, and the stock is still up by 4% so far this morning. Coming up next, we'll catch up with Matt Stuckey of Northwestern, former Kansas City Fed President Esther George, and David Seith of Nomura.
It's really hard to have any kind of negativity on the U.S. market.
The setup here
is that it's all about tech.
Expectations right now are much higher than they've been over the last 3 years.
Just meeting earnings is not enough.
Anything that looks like it's going to threaten that earnings picture is going to be problematic.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the third hour of Bloomberg Surveillance starts right now. Your price action looks like this. Looking for day 5 days with no losses on the S&P 500. We've had 4 so far. On the S&P, we're higher by 0.25%. On the Nasdaq, up by 0.6. In the bond market, a total snooze. Going into the Fed's 2-day meeting, bond yields higher by just 2 basis points, still around 420 at 422.93. Let's see if that changes. Heading into tomorrow, the big one tomorrow afternoon, a Fed decision followed by tons of tech earnings after the closing bell. We'll hear from Meta, Microsoft, and Apple on Thursday.
And just how high the bar is for these tech earnings, especially given the fact that everyone continues to want to double down when it comes to tech. They're moving away from the U.S. dollar when it comes to sell America, but they're not necessarily moving away from the tech earnings. We are in a bull market, but can they continue to basically justify all the CapEx spend we have seen from these companies?
AMH, you mentioned the U.S. dollar. Let's talk about it. In FX right now, the Bloomberg Dollar Index down to levels we haven't seen since February 2022. 4 days of weakness, a lot of weakness very recently.
A lot of weakness when it comes to the U.S. dollar, and where is all this going? Everyone is talking about this gold trade in precious metals and also silver. There's a joke going around on Twitter that actually if you win the Olympic medal for silver, you're going to want to maybe swap it with the individual that won for gold. Silver and gold last year had their best year since 1979. Every bank on Wall Street is talking about the fact that now for gold, maybe the spring we're going to see targets they thought we were going to see the end of this year. RBC Wealth Management talking about $7K a troy ounce by the end of this year. So you have that debasement trade just continuing, and it's continuing sharply this morning.
Explosive moves in precious metals, tons of volatility in something like silver. Silver up by 8% right now. Gold is up by about 1.7 after big moves already so far year today. Coming up this hour, we'll catch up with Matt Stuckey of Northwestern Mutual Wealth Management, with stocks trading near record highs. We'll speak to the former Kansas City Fed President Esther George, looking ahead to tomorrow's Fed rate decision, and David Seath of Nomura as another government shutdown is looming. We begin this hour with stocks pushing towards fresh records as a key week of earnings continues. Matt Stuckey of Northwestern Mutual Wealth Management writing the following: given elevated valuations and very tight credit spreads, earnings growth is likely to be the bigger driver of equity returns looking over the next year or two. Matt joins us now for more. Matt, welcome to the program. Just how much of the heavy lifting will be done by a handful of tech players?
Look, I mean, I think tech is going to continue to be the main earnings growth driver for the S&P 500, and it needs to be given the concentration levels of the S&P 500. However, that's not where the fastest earnings growth is as an asset class. Certainly big tech is going to continue to do well, but since earnings estimates bottomed in mid-May of 2025, the fastest earnings growth is in the Russell 2000. Blended forward 12-month earnings estimates are up around 25% from that kind of low water mark. The aggregate S&P 500 is up 14% or so, and that's one of the reasons why you're seeing the broadening happen in markets. Just the last 2 or 3 years, if we're looking at kind of the percentage of S&P 500 companies that outperformed the aggregate index, it was between 20 and 30%. And so over the last 4 months, you've seen that push up north of 60%. Earnings growth is going to be the big lifeblood going forward, and it's the key to continued broadening trade as we look in 2026.
Well, Matt, I think that's the right question to be asking. Just how much life does that broadening trade actually have? And does it go well beyond just a short-term rate cut story like we saw at the back end of last year? To your point, earnings, a better backdrop for growth for the year ahead. Do you believe it has legs?
I think it does. And certainly additional rate cuts from this point forward would be helpful. But don't forget the rate cuts that we have in the rearview mirror that take time to work itself through the economic system. I think that's really what's pushed up earnings estimates so far this year. And as the world has adjusted to higher rates, and now they've come down somewhat. I think just the passage of time is also a factor to benefit kind of more areas of the economy pushing forward and pushing estimates higher on the earnings side of things. The other area that we can always point to is just the value dislocation, that the setup has here for different areas of the market complex outside of the S&P 500. On a forward-looking basis, you're seeing 7 multiple points of discount for things like small cap relative to the S&P 500. That's been persisted the last few years, but it's starting to get unlocked now that earnings growth is starting to be a driver in terms of growth going forward.
Is it being unlocked because of productivity, or to John's point, because maybe we are going to get more of those rate cuts?
I think it's a combination of things. So it is partially due to rates coming down. We get some cyclical parts of the economy to stop, basically just treading water, moving sideways, and start to grow again. But also, if you think about the secular horizon, if artificial intelligence is going to unlock a lot of productivity across the economy, think about the labor intensity of things like small cap and mid caps, and really where the torque might be in terms of using those productivity benefits to drive earnings estimates even higher. So to me, productivity as well as cyclical recovery are keys on a go-forward basis for this broadening trade to persist in the upcoming year.
You don't think that the Fed is going to cut or do anything this week, but you do say at the press conference will likely be the only source of volatility. What are you expecting from Jay Powell?
Well, I think he's going to be deflecting a lot of questions from your colleague, Mike McKee. But in terms of just the ongoing messaging, I think, maybe some urgency is starting to leave the room in terms of the necessity for additional rate cuts, just based on, a couple of back-to-back labor reports that didn't show, continued deceleration in the labor markets. However, I think, the messaging is going to also have some positive nuggets for equity investors out there, just that, the continued kind of view on the inflation lens maybe separate some of the inflationary impacts from tariffs, and if we adjust for those, that they're continuing to see progress on inflation moving back to their 2% mandate. And so, if there is any volatility, it's probably in the press conference. But I think if we're looking at this, it's unlikely to be the type of fireworks show that we've seen in prior meetings.
Yeah, Matt, to your point, the fireworks might be after the closing bell, when we hear from Meta and from Microsoft, two companies in two different positions, both spending a lot of money. But do you expect to see more performance dispersion within that cohort of massive companies?
Well, I think along with the results, the plans for CapEx are a huge watch point for the S&P 500, because if we're looking, at this point a year ago, what these companies were saying they were going to spend in CapEx versus what they're saying today is 80% higher. And that revision higher in terms of capital expenditures has been a huge driver of earnings growth for the largest technology companies. And I'm very interested in seeing what they have to say about, plans moving forward. Do those get revised even higher from where they sit today? In terms of, specifically to Microsoft and to Meta, I do think that both of those names actually have a little bit of upside in front of them, just given, some of the weakness we've seen relatively in their performance, and expectations as a result are somewhat more muted for these companies versus just 6 months ago.
Matt, the market reaction function seems to have shifted in the last 6 months as well in the face of increased CapEx spend, particularly with a company like Meta. Is that the risk into tomorrow afternoon?
Yeah, that's an interesting question. Unlike the Oracles of the world, the vast majority of Meta spending has been cash flow financed. And so, they have the ability to adjust up or down, just given, their enviable financial position. I think investors are starting to demand a little bit more in terms of line of sight on returns on that cash flow spend in the form of additional CapEx. However, I do think that they have a lot of options in front of them, just in terms of if they do need to adjust and continue to show, ongoing efficiency gains in their business. To me, I think that they have a lot of options that they can lean into here.
Is there a lot of investor tolerance left? Matt, that's kind of what I'm getting at. Are we reaching the point where investors are starting to push back?
I think so. Just in terms of, you've seen the multiple compressed for Meta. I think that's a sign that investors are losing a little bit of patience. However, you have to go to a lot of other companies outside of Meta to find, the attractive balance sheet health as well as cash flow and earnings growth. So to me, I think that they can have the enviable position of being able to navigate these evolving landscapes from a position of strength. And so we'll stay tuned and see what they say at the upcoming earnings report. But I don't think they're necessarily going to be disappointing in terms of the expense growth that we see for 2026.
Matt, it's good to see you. As always, Matt Stuckey there of Northwestern Mutual Wealth Management. Looking ahead to the Fed, hit snooze apparently. You can skip that. According to Matt and to many others as well, after the closing bell tomorrow, Meta and Microsoft. The day after, we'll hear from Apple. Then the following week, we'll get Alphabet and Amazon. Equity futures doing okay, up by 0.25% on the S&P. With an update on stories worldwide with your Bloomberg Brief. Back with us, here's Yahira. Hey, Yahira.
Hi, John. Shares of major U.S. health insurers are plunging this morning after a proposed plan to keep payments to private Medicare plans essentially flat next year. Medicare Advantage payment rates will rise by just 0.09% in 2027, which is much, much less than what was expected. The proposed policies will mean barely any increase for Medicare insurers that have seen profits squeezed by rising care expenses. Meanwhile, speaking of Meta, it's planning to test new subscriptions that will give users exclusive features on its apps. TechCrunch reporting Meta will test the premium subscriptions on Instagram, Facebook, and WhatsApp. The subscriptions will unlock more productivity and creativity, according to Meta, along with expanded AI capabilities. And U.S. airlines are cutting flights as freezing temperatures hamper the restart of operations at some major hubs. According to FlightAware, almost 1,000 flights were canceled as of 1 a.m. Eastern this morning. The industry is also bracing for further disruptions as the National Weather Service warns of another potential significant winter storm later this week. That's your Bloomberg Brief. John.
Yahira, thank you. Thanks for the update. More from Yahira in about 30 minutes' time. Up next, we'll get you some morning calls. Plus, we'll catch up with the former Kansas City Fed President Esther George, looking ahead to tomorrow's Fed decision. Live from New York City this morning. Good morning. You're watching Bloomberg TV.
It's not a big thing to say that there is a high bar for earnings to jump over. It's not to say it's not achievable. There's a lot of parts of the economy that didn't experience great earnings growth over the last couple of years because of the concentration in just Mag 7. But that is still an extraordinarily high bar for this market just to meet expectations, let alone beat them.
That was Cameron Dawson of New Edge Wealth going into Mag 7 earnings season. It kicks off big time tomorrow after the closing bell when we hear from Meta and from Microsoft Thursday. Results from Apple. Into that, futures positive by 0.25% on the S&P 500. On the Nasdaq 100, higher by 0.65%. The S&P within striking distance of all-time highs, within 0.5% of a brand new record. Look out for that around the opening bell. That's the price action. Let's get you some morning calls. First up, Bank of America cutting its price target on Amazon to $286. The firm citing multiple compression in Amazon's software business. That stock is up by 0.8%. Your second call from Roth Capital raising its price target on Alphabet to $365, expecting it to beat estimates in its fourth quarter report. That stock is up by another 1.3%. And finally, Deutsche Bank upgrading CoreWeave to a buy, citing opportunity for it to differentiate versus its peers. That stock is higher again. It's up this morning by close to 5%. Let's turn to the Federal Reserve. The central bank is set to make its first rate decision of the year tomorrow as threats to Fed independence build. Joining us now is the former Kansas City Fed President, Esther George. Esther, welcome back to the program. Before we get into the substance, the economic backdrop, the policy, I want to pick up on the more assertive stance, the more aggressive posture, if you will, that Chairman Powell seemed to be taking this year to defend central bank independence. I'd love your reaction to that and whether you believe he'll carry that into the news conference tomorrow afternoon.
Yeah, good morning, Jonathan. I think the chairman had to take this move. I think we have been dancing around these threats to independence and really trying not to make too much of it. But I think the chairman reached a point where he really did have to speak out and send a message to the public about how important the decision-making of the central bank is, that it not get caught up in political issues. And as you saw, The reaction from around the world, from former policymakers, was quite supportive of that, as was I.
That's when it comes to the video he released in reaction to the subpoena from the DOJ. But he also recently went to the Supreme Court to attend the hearing of Lisa Cook. And the administration said that he was now politicizing that hearing. What's your reaction to that movement from Jay Powell?
Well, I think the Supreme Court's decision is absolutely consequential to the future of the Federal Reserve and thinking about how this body will weigh in on the ability of removing Fed governors. So clearly, I think as a leader of this institution, his interest would be high in understanding how the courts might be talking about this and what the arguments are that are presented. I didn't view that as a political one.
Given these stances we have seen from him, do you think in the press conference he's going to be more willing to engage when reporters obviously ask a number of questions that are really on this line when it comes to politics?
Well, I'm quite sure he's going to get a number of questions, and I suspect he will address them. At the same time, though, trying to keep the focus on what it is this committee is really focused on, and that is responding to economic conditions in the United States. And so, yes, I think he will have to address what are likely to be a number of questions, and he may do so in the fashion he did in his previous statement. Again, bringing it back, though, to this is the job of the central bank and where he most likely will want to focus today.
Esther, do you think that the economic backdrop at the moment gives them the space to hit pause for a little while?
Yeah, I agree that it's time to take a breath on these rate cuts. They've made a number of cuts that are still feeding through the economy. And so I think it makes sense in the face of elevated inflation and what seems to be coming this year that it would be a good time to pause and really take stock of how they assess the economy on both sides of their mandate.
What do you expect is coming this year on the inflation side?
Well, my own view, Jonathan, is that inflation is something we've got to keep a careful eye on, because I continue to hear this idea that the full impulse of the tariffs has not fed through yet. I think companies have been trying to do their best in managing, pushing through those costs, but you could expect, I think, that the first half of the year we will see more price pressures coming in there. You have easy financial conditions now, and you have a fiscal situation that I think is going to be a tailwind, both on the consumer side and business side, with some of the new rules coming into play. And so I think all of that should make us very cautious about inflation expectations, staying firmly anchored at that 2%. Really raising, I think, the attention that the Fed has to pay on that inflation mandate.
I understand your concern about inflation potentially pushing higher, but hasn't the Fed basically acknowledged that they're no longer looking for a 2% target, given how many cuts we've had, and it's been closer to 3%?
Well, they've certainly moved in the direction of putting more weight on the labor market part of their mandate and have emphasized that. And I think, fair enough to look at that, because you have seen a dramatic change in the data from a labor market that was really tied a number of job openings, and that's sort of reversed and pulled back. At the same time, though, this is a Fed that just released its framework saying 2% was the target. They have to keep their eye on inflation expectations. And the truth is, households and businesses are beginning to agitate a bit, if you will, even in these survey measures about their concern about future inflation. So I think it's a very good time just to reassess and be quite confident about your assessment of inflation before making further rate cuts.
When it comes to the potential tariff pass-through, we have heard from Amazon. They're saying that more of the tariff pass-through is actually starting to creep into some of the prices. But do you think that consumers will bear the brunt of it, or really will it still be corporate America that tries to bear the brunt of it this year as well?
Yeah, Marie, we'll have to see how this plays out. I mean, so far, I think businesses have been very careful not to overwhelm consumers with these price increases, but there is a limit to that, as you know. And I think consumers have been bearing the cost of this, And I think they will continue to. We saw some of that, I think, come through in the Fed's Beige Book most recently, to say that is still very much on the minds of businesses as they come into this new year.
Esther, it's so strange to have a conversation right now about this really robust backdrop for economic growth. At the same time, we have these concerns about a weaker labour market. What do you think explains that disconnect of the last 12 months? And do you see it reconciling in the next 12?
Well, it's easy to start with the data, Jonathan, and say, the government shutdown gave us a little scramble as it relates to that. So it's going to take a little while, both on inflation data and labor market data, to work through that. But I think we also have to recognize that while demand has come off, and you can say demand came off from employers because of uncertainty, because of making more technological investments that would substitute for labor, you've also seen the supply side be hit directly too. And so those two things have left us with an unemployment rate that looks pretty low all in, but it does make you ask questions about where that labor market is headed when, people characterize a low hire, low fire environment, and you see very narrow sectors of the economy that are actually adding labor. So again, I think all of that weighs in the balance for the Fed of saying, let's wait and understand, given what we've done so far, what these dynamics are in the labor market.
Esther, it's good to see you. Thanks for dropping by. A big meeting for the chairman tomorrow, and not on policy, but on the politics. Esther George there, the former Kansas City Fed president, ahead of that meeting. Two-day meeting begins later on this morning, concludes tomorrow. The news conference with Chairman Powell tomorrow afternoon. Full coverage here, of course, on a special edition of Bloomberg Surveillance. That disconnect between growth and payrolls is intriguing for many people. I think there is an obvious supply side response that you can make. You can say that obviously immigration is much tighter over the last 12 months, but unemployment started to bleed a little bit higher as well, which gave some people on the committee, enough people on the committee, reason to reduce interest rates.
But they did it 3 times now, which is why Esther George thinks it's time for a pause. And there are individuals that are concerned potentially this year more tariff pass-through. She says they're still committed to their 2% target, even though they continuously cut when it's close to 3. But it's a very precarious moment. You have Atlanta GDP sticking to 5.4% growth. A lot of individuals are talking about an economic boom. CEOs saying they're amped up for this upcoming year. And at the same time, individuals on the Fed are concerned about potentially making sure the economy can grow and not have weakness in the labor market.
And now we've got this disagreement over inflation. Esther George suggesting things might pick up towards year end off the back of fiscal stimulus, tax refunds, a better backdrop for economic growth. Peter Chia of Academy, by the way, saying this Fed is so focused on missing transitory that they'll miss inflation falling, that the tailwinds for disinflation are strong enough that the opposite story's going to be the story of the year.
Which is why it is challenging to decide what you think the Fed is actually going to do, because a lot of people have a different take on where inflation is going and also where the unemployment rate is going. I thought it was interesting, once again, we heard from Torsten Slok talking about really it's going to be a blockbuster year this year when it comes to the fiscal impulse, the tax rebates we're going to get. And then we heard from Cameron Dawson, it's an election year. What is going to be the impulse of Washington to spend and make sure consumers are shored up?
The great debate of the moment. For the market, it speaks for itself. Rate volatility is low. The bond market's still somewhat range-bound. The 10-year at the top of a recent range. The 10-year bond yield at the moment at about 4.23. Coming up next, we'll catch up with David Seif of Nomura as another government shutdown is looming. Plus, Danny's back. She's got your morning movers. GM rising on a fourth quarter beat. GM in the pre-market up by 4% from New York City. This is Bloomberg. So this is what the Treasury Secretary said in the last 24 hours. I was in the Oval with the President today. He spoke to Prime Minister Carney, who was very aggressively walking back some of the unfortunate remarks he made there at Davos. So here's Prime Minister Mark Carney this morning speaking to reporters. He does not regret the speech made in Davos, and he doesn't appear to be walking anything back.
Well, the prime minister also didn't mention Trump by name. I think the administration took it as a slight to the administration, especially when Trump got up there, gave his speech and said, Mark, maybe think twice next time you give a speech. But to Mark Carney's point, he's not making a U-turn, even though certain Europeans that want to distance themselves from Ottawa and that, like Christine Lagarde. He didn't actually mention the U.S., but it was pointed to the U.S. He was talking about what he called coercion. I love that line about middle powers. That's what everyone kept coming up to me talking about at Davos. If you're not at the table, you're on the menu. Mark Carney standing by his words.
The tension between the US and Canada continues to build. Let's turn back to the price action. Equities look like this. Equity futures on the S&P still positive. 4 days, no losses on the S&P 500. Can we make it day 5? We're up by 0.2% on the Nasdaq, higher by 0.6 tomorrow. Earnings from Microsoft and Meta in the bond market. We've talked about how quiet things are given the risks elsewhere. The 10-year bond yield at 4.23. Yields creeping just a little bit higher at the long end of the curve this morning, up by 2 basis points on 10s and 30s. And even with that move, this dollar a little bit weaker. The Bloomberg Dollar Index at lows we have not seen, the weakest level since February 2022. The dollar's weaker and gold is at fresh all-time highs.
Gold just continues to go higher, and so does silver. After having their best year for both of these metals since 1979, they are coming out in the new year absolutely swinging. You are seeing banks lift their forecast for their 5K was supposed to be the end of this year. Now that's the end of January. They are talking about maybe 7K by the end of this year when it comes to the precious metal.
Gold up another 1.5% this morning. Silver up by close to 8. As we count you down to the opening bell, about 1 hour to go. Let's get your morning movers with Danny Berger. Hey, Danny.
Hey, John. Kicking things off with GM earnings. A big showing from them, increasing profit by $2 billion. A $6 billion share buyback authorized too. People are buying the big SUVs, even if they are buying less EVs. Shares up 4.2%. Elsewhere in earnings, diverging fortunes between the airlines. American Airlines shares are up 3.5%. Yes, they missed on their earnings, but gave an upbeat forecast for 2026, despite the fact they are seeing an impact from the winter storm this past weekend. For JetBlue, it continues to be their lack of being able to capitalize on moving into more premium offerings. Their loss is wider than expected. Shares down 5% in the pre-market. Finally, the healthcare providers, they are getting hit. The insurers in the pre-market by a huge amount. The plans going to Medicare companies, the private ones, the payback from the government, smaller than expected. It's basically flat on the year, 0.09% raise. Expectations were as high as that paybacks would be lifted as much as 9%. And on top of that, some pretty weak earnings from United Health, and shares are down as much as 15.5% this morning, John.
Danny, thank you. Thanks for the update. More from Danny in about 30 minutes' time alongside Matt Miller to take you into the opening bell. JetBlue needs a rebrand. The business product is pretty decent.
Mint, right?
Yeah, I think the Mint product's pretty decent. You can question whether they've got the right routes. People obviously don't carry the credit cards to get the points, so they wouldn't spend them on JetBlue. They'd like to spend them on, say, Delta, whatever. The product's actually decent. I've flown JetBlue Mint in the past, and it's as good as the others.
I'm with you. Because you told me it was so good, I decided to try it once on a flight to LA, and I was shocked. The food was really good, really nice eye mask that they delivered, really nice pillow, but they don't actually market it the way you feel it in the cabin.
The brand feels like Spirit.
Yes.
That's the way I think people perceive the brand to be, but it's certainly not.
Growing up, JetBlue was always supposed to be a cheap way, I remember, to get to Florida if you wanted to go to Miami or go to Disney World from New York. Now, if they have a premium product, they have to do a lot of convincing to the consumer that has more of a nostalgia, cheaper JetBlue in their mind.
That's the latest on the airlines stage side. Let's get back to the Federal Reserve. Two-day meeting begins later this morning. Interest rate decision tomorrow. Bloomberg's Mike McKee joins us now for more. Good morning, Mike.
Good morning, John. Well, in about an hour, the Fed meeting starts. And speaking of airlines, we hope everybody on the Open Market Committee made it to Washington, given all of the travel interruptions that we have seen. Along with the Fed meeting starting today, we get consumer confidence. This will be kind of important, more than usual, in the sense that everybody wants to know whether the consumer is pulling back or not and how concerned they are about what's going on in the United States these days. Tomorrow, of course, all eyes on the Fed decision at 2 p.m. Eastern Time. Thursday, jobless claims, trade balance will make a big difference in the GDP numbers for the fourth quarter. So a lot of people looking to that. And then Friday, December PPI is going to be really interesting because you take the December PPI and the CPI numbers and people can figure out what PCE is going to be for December. And some of the experts in this are already saying they think it will go up over 3%. If that were the case, that gets the Fed's attention and makes a big difference. The other thing that makes a difference this year, maybe the change in the Fed voting roundup, the number of the members who are now going to be voting, including Beth Hammack, Lori Logan, Neil Kashkari, and Anna Paulson. They kind of replace people who have the same views from last year. There's a feeling they'll get more hawkish, but really it's Hammack and Logan who are hawkish, Kashkari in the middle, and Paulson is kind of dovish. And then there's always Stephen Myron. He's still around. His term ends on Friday, but he can stay till someone else replaces him. Someone else is nominated by the president, and we expect him to dissent on whatever decision the Fed makes. And then the big question, of course, on Friday is, does the government shut down at midnight? If so, do we go right back into the data hole that we have been? ISM manufacturing. Well, you can see on the left-hand side is what we will get, the private sector numbers, ISM, the ADP numbers, Michigan sentiment. What we wouldn't get is December retail sales. We don't have a specific date for that, but it would be in jeopardy. Durable goods orders, housing starts. JOLTS and jobless claims. People want to see that. But, of course, look at the big one on Friday, the January jobs report. Not only do we get that, but we get that revision to show how fewer jobs were created in 2024-25 that everybody has been pointing to.
Mike, it's the time of month where we typically field loads of questions that people want you to ask in the news conference tomorrow. And I have to say, the questions we've had so far, they have nothing to do with the data. They have nothing to do with monetary policy decisions. They have everything to do with the chairman's more assertive stance to the White House a few weekends ago. And they want to know, Mike, whether he'd be willing to engage in a conversation, at least tomorrow afternoon, about what he's going to do after May.
Well, we'll find out because no doubt, John, somebody's going to ask that question. I certainly would if I'm the first one called on. But does the chair want to continue engaging with the White House and perhaps ratcheting up the temperature, knowing that it would have an effect on Wall Street? Or does he want to disengage? Does he want to say, I stand by my comments, but I'm not going to have anything further on that? That's going to be the real question. What's the strategy at the Fed for handling this?
Mike McKee, thank you, sir. Mike McKee in the news conference tomorrow afternoon. And Mike's right. What is the strategy? Because the strategy appeared to change a few weeks back.
Yeah, there was a huge turning point after the DOJ sent the subpoena over that Friday. Chairman Powell also waited till Sunday when the markets were just about to open in Asia, or maybe they just did open, when that video was actually released. He could have released it Friday night. Saturday he had all day. Markets were closed. He waited till Sunday night and decided to send out this video. Then on top of that, the administration said he's being political by showing up at the Supreme Court hearing of Lisa Cook. So January, we have seen a very different Jay Powell show up when it comes to these issues that many in Washington would say are very political. So does he engage at least a little bit with some of the reporters?
Let's stick with Washington. David Seif of Nomura writing the following: a partial government shutdown seems fairly likely to begin the weekend, with Democrats refusing to support DHS funding following the recent events in Minneapolis. David joins us now for more. David, good morning.
Good morning.
Is any of that consequential for the world that we track?
You know, it's consequential for we economists who may once again lose access to data. But the economy is just trudging along, doing so well, despite all the chaos, for lack of a better word, that is out there. We've had a couple of great quarters of growth, and we think that Q4 and Q1 of this year are also going to both be fantastic quarters for growth.
So in terms of damage, if there was to be a partial government shutdown, would it do any damage to growth?
We think it would be more of a rounding error than anything. I mean, I don't want to say zero, of course, but we didn't see a huge amount from the government shutdown that was the longest we'd ever had. This would, first of all, only be a partial shutdown, so a lot less would be affected, and we would expect it to last a much shorter period of time if it were to occur.
If it's going to last a shorter period of time, what's the off-ramp? How do they figure this out when it comes to DHS funding? Because Senator Schumer says he's not voting for those appropriation bills unless DHS funding is delinked.
Yeah, well, I think that Schumer and most of the Democrats are going to be a no almost no matter what. The key thing is, can you get that handful of moderate Senate Democrats to go along with it? And you have heard at least some softening of the rhetoric from some of the more moderate Democrats, including some of the ones who are retiring, who want to do a little bit less posturing. So I think there is a deal to be had. It's not quite clear how much the White House would need to give, and it's not quite clear how much they're willing to give.
Speaking of posturing, tomorrow's news conference with the chairman of the Federal Reserve. Do you expect that to be about policy or politics?
I expect it to be a lot more boring than people are hoping for it to be, probably.
Boring?
Yeah, I think
Fireworks.
Powell, well, the questions may be interesting. I just don't think the responses will be all that interesting.
Well, that's the important question.
Yes.
Because I would have agreed with you 3 weeks ago, 4 weeks ago. Then something changed, something snapped for Chairman Powell.
I think that's right. But I don't think we're going to get another round of that at this specific press conference. I mean, the first thing is that these press conferences, it's really the job of the Fed chair to represent the views of the committee, whereas any other time, a Fed speaker is speaking for him or herself. And so this may not be the forum for that. I would expect Powell to largely refer to previous speeches, say that he's allowed to attend a Supreme Court hearing if he wants to, and really not be willing to engage on that front, even though I know that's what we all probably want to hear more of.
I'm looking less forward to now this press conference if you don't think he's going to engage. But if we sit on the Fed and the race, what's going on right now, we spoke to Senator Thom Tillis in Davos, and he was pretty emphatic. He is not moving. Not because of the person, because of the process. The DOJ subpoena, all of what's going on in that investigation into Jay Powell and the Fed needs to be wrapped up before he moves. Do you think we can have a much longer Powell-led Fed, given what is going on in terms of this investigation?
Well, certainly if this were to extend beyond the June meeting, so the middle of June, Powell most likely would be selected as chair pro tempore and therefore be allowed to continue running on a meeting-by-meeting basis until his successor is confirmed. I think, though, that the administration would really like to avoid giving Powell even one additional meeting. And so it just puts a lot of incentive on the DOJ to wrap this up sooner rather than later, because Tillis's threat is extremely credible. He can do it. He seems set to do it. And so I think the real pressure is to get this wrapped up in a few weeks.
But given that, and we have not heard from the Oval Office yet on who the president is going to be picking, do you think they are going to push this down, kick the bucket down when it comes to deciding on who's going to lead the Fed?
I do think that. But, in fairness, we've actually at Nomura been saying for quite some time that we thought this was going to be a much longer selection process than expected. Trump has historically taken a good deal of time to come up with decisions for important candidates. And then more than that, it seems as though he's not terribly thrilled with any of the candidates. He, on the one hand, seems to have soured a little bit on Kevin Hassett, who was seen as sort of that big insider. But you've had other comments, maybe they've gotten a little bit less press, but I think they're important, where he talks about, well, I'm a little worried about selecting somebody who acts like he or she is going to do what I want them to do, but then changes their mind. And this is a job where he can't fire the person, as he knows also well. So it's that much more important, presumably, to the president to pick somebody who he sees as a real dyed-in-the-wool loyalist.
Does this make it harder for you to forecast policy for the year ahead?
Well, we think there's going to be 2 cuts under the new Fed chair. And that is really based on the politics and the changing dynamics of the Fed, much more than on the fundamental economics of it. We think no matter who Trump does end up with, it will be a very dovish shift on the Fed as a result of the new chair, and that the committee will give at least some deference at the beginning to that new chair, allowing a couple more cuts.
David, it's good to see you.
Always a pleasure.
Thanks for dropping by. Thank you, David Seif there of Nomura. That Fed decision tomorrow afternoon. Let's get you an update on stories worldwide with your Bloomberg Brief. Here's Yahara Arnold with more. Hey, Yahara.
Hi, John. President Donald Trump is threatening to raise tariffs on South Korean goods to 25% from 15%. In a post on Truth Social, the president saying the country's lawmakers have not lived up to the deal they agreed to, with the new rate applying to autos, lumber, pharmaceutical, and other products. Meanwhile, Microsoft is rolling out its new Maya 200 AI chip as it pushes to provide an alternative to NVIDIA hardware. The chip will power Copilot for businesses and the latest OpenAI models on Microsoft's cloud. The company says Maya 200 beats comparable chips from Google and Amazon on some tasks and is its most efficient system yet. And a new documentary film about First Lady Melania Trump is struggling to fill theaters. Boxoffice.com projecting $1 to $2 million in opening weekend ticket sales. The film was purchased by Amazon's MGM Studios for $40 million, and the company is spending an additional $35 million on marketing. That's your Bloomberg Brief. John?
Yahara, thank you. Thanks for the update. Up next, setting you up for the day ahead, we'll catch up with Nisha Patel of Parametric, expecting the Fed to hold interest rates steady at tomorrow's meeting. From New York City, you're watching Bloomberg Surveillance.
It's time to take a breath on these rate cuts. They've made a number of cuts that are still feeding through the economy. And so I think it makes sense in the face of elevated inflation and what seems to be coming this year that it would be a good time to pause and really take stock of how they assess the economy on both sides of their mandate.
That was the former Kansas City Fed President Esther George weighing in on the Federal Reserve. That two-day meeting begins a little bit later this morning down in Washington, D.C. It concludes tomorrow afternoon. That news conference with Chairman Powell is just around the corner. As we count you down to the opening bell, equity futures doing okay, just about positive on the S&P 500, up by 0.2%, up by 0.5 on the NASDAQ 100. Just a bit of weakness creeping into the small cap trade. A lot of bulls out there on the Russell, a little bit of weakness, back-to-back losses on that particular index over the last 2 days. This morning, some underperformance once again. As we count you down to the cash open, just around the corner, about 41 minutes away. This is what the next few days look like at 4 p.m. Eastern Time. The president speaking in Iowa. Tomorrow, an FOMC rate decision and Chairman Powell news conference, plus earnings. Microsoft, Meta, Tesla. Thursday, more data, another round of jobless claims. And Apple earnings. Friday, more data, PPI. And the government funding deadline going into the weekend, which has all of a sudden become an important topic.
I know. Henry and Trey's 2 weeks ago had it at 25%. Now it's north of 70%. You heard from David Sieve. He's talking about, yes, likely a partial government shutdown. We are hearing, though, as opposed to the fall, a lot of individuals say we need an off-ramp for this. So maybe it doesn't go as long. But potentially, this is going to interrupt some of the data we're expecting next week.
Well, let's turn back to the Federal Reserve. This is what Nisha Patel of Parametric has to say. The expectation is a hold this week. This is less higher for longer and more steady for longer. Nisha joins us now for more. Nisha, good morning.
Good morning.
Is that independent of who the next Fed chair is?
I think it is. I think you're going to need to see a significant change in the data, even if we have a new Fed chair. Now, there's a difference between perhaps market and the optics of who the Fed chair is and obviously the pressure. But it's also a good reminder that this is a committee decision, right? So I think you're going to need a lot of support within the Fed to see a fairly significant shift in data before more Fed cuts are warranted.
We've had a significant shift in the Fed funds rate already. We had 3 cuts last year. We had a number of cuts the year before. We often talked about this money sitting in cash, parked in cash. When the rate cuts come, they'd pile back out. Have we actually seen that?
We haven't seen that. And in fact, I mean, you can say money market fund AUM has hit all-time records. So it seems like, you know, we're not seeing as much of a rate-sensitive investor as we thought. But I do think that if there's a catalyst, and I think there's a lot of expectation that perhaps we see steady for longer in the first half. However, if we do see a drop-off in the labor market, right, that's the key piece here. Inflation seems to be cooling. Inflation seems to be headed in the right direction. If we see anything on the labor market side, I think that's where you can garner support from the Fed and the committee to warrant more rate cuts. So if we see that, even 1-2 more rate cuts, and you start to see a shift in the language, I think that's when you could start to see more of this momentum coming out of cash. And then I would also say, you know, when you take a look at equity valuations, perhaps you have investors pausing, right? And then they're saying, look, if I'm earning 3.5-4% in cash, I'll sit here longer. I would make the argument at some point fixed income starts to look compelling to start locking that in for longer.
When you say the Fed may have to change its stance when it comes to the data, what data exactly? Is it just the unemployment rate? Is that the only thing we should really be focused on?
I think it could be a series of data that is pointing to a weakness in jobless claims or an increase in jobless claims, and you start to see some of this perhaps ahead of time. And then it is going to be an uptick in unemployment data. Hopefully we see a little bit more guidance from the Fed this week on what exactly it is they're looking for, right? For a long time, it was a focus on inflation. And it was a 2% target. They less kind of focused on that number. Now it's the new 3%. Perhaps there's some metric that they will point to that sets up and opens up the door for them to cut if labor market weakness actually starts showing up.
So for this meeting, you're looking for direction of travel from the chairman.
Yes.
And you think he's going to be biased towards the labor market?
I think you'll see more language around the labor market, although I'm not sure in this meeting we're going to see exactly that, right? I think with Chairman Powell, he will hold a stance of saying, look, we're where we need to be. We haven't seen any change in data. With the government shutdown, we need a series of more. And so perhaps we don't see exactly that this week, but I think you could start seeing that in the coming months.
Is he where he wants to be? Is a different question that some people might ask in that news conference tomorrow.
Oh, yeah, I know. I think he's hoping people ask questions like this. What data points should we be looking at? Because the questions are going to be, sir, tell us about your dealings with the Department of Justice, the Supreme Court, and the Oval Office.
You stand beyond May. I think 5 different ways of asking that question already prepared going into that news conference. Markets look OK, within striking distance of all-time highs. Junk debt sales in the last couple of days, last 24 hours picking up. IPO window saw several headlines to start the week. That feels like that's open. You've talked about being up in quality. Are you maintaining that discipline, given the frothiness, just pockets of it, developing elsewhere?
I am. And I think there's 2 disciplines that you want to really focus on in fixed income portfolios. So the first is on credit discipline, right? Especially where in this environment spreads are tight and investors are not necessarily getting paid for the extra risk. So I think this is an environment where you do want to be up in quality, especially if this is meant to be that ballast, right? I bring back kind of why fixed income today. Real yields are high. You are looking for possibly a diversifier in portfolios where portfolios may be overweight equities. So credit is certainly a key component. And then the duration management, right? So I think just looking for duration management, you could look at this as a good entry point, but really being able to shift in these portfolios is going to be key.
Nisha, good to see you.
Yeah.
I won't ask your favourite for the next Fed chair. I mean, you can answer that if you want, but I imagine you're not. So I won't ask. Nisha, it's good to see you.
Good to see you too.
Thank you. And you're probably happy I didn't ask. Not directly anyway. Nisha Patel of Parametric. Nisha, thank you. Coming up tomorrow, Keith Lerner of Truist Advisory, former Kansas City Fed President Thomas Hoenig, Priya Misra of JP Morgan, Aditya Bave of Bank of America. That 2-day Fed decision begins later this morning, concludes tomorrow. I'm not sure that's the main event based on expectations we've heard so far this morning. A lot of people think it'll be a snoozer. Maybe the main event's going to be the earnings in the afternoon.
Absolutely, especially when you have Mike McKee basically saying he's going to stick to representing the deliberative body and not getting into the politics when it comes to those high flyers, those hyperscalers. The CapEx is going to be incredibly important. Can they justify it?
We are within 0.5% of all-time highs on the S&P 500. Equity futures this morning positive by 0.2. From New York City, this was Bloomberg Surveillance.
Day 9 at the Australian Open. Jessica Pegula ended Madison Keys' reign as champion down under in straight sets to reach the quarterfinals for the 4th time. She'll face another American, Amanda Anisimova, for a spot in the semis. A 2-time champion, Yannick Sinner, eased past compatriot Luciano Darderi in his round of 16 showdown. Up next for him, 8th seed Ben Shelton.